Well, thank you all for getting up a little earlier this morning and coming in earlier. I appreciate that. I think we're ready to start today, and I think we're going to have an economic presentation this morning. So, Chris, I'll turn it back over to you.
Thank you, Mr. Arbitrator, members of the panel. This morning, we will present the testimony of Jeremy Krimmel. The Commonwealth has been gracious enough to accept Jeremy Krimmel's credentials in terms of his status as an economist, and so we will not vordeer him regarding his credentials and his ability to testify as an economist. For the benefit of the members of the panel, however, in tab number 2 of your book is Jeremy's curriculum vitae. So without further ado, Mr. Krimmel, can you state your name and spell your name for our record today?
Good morning. First, let me test the microphone. Am I audible?
Pull it probably within about 6 inches of your mouth.
Okay, is that better? Okay. So good morning. My name is Jeremy Krimmel, and that's spelled J-E-R-E-M-Y. Last name C-R-I-M-M-E-L.
And could you briefly tell us who you're affiliated with?
Yes, so I'm affiliated with the PSCOA as their economist.
Say that one more time.
The PSCOA as their economist.
Okay, and who do you work for outside of the PSCOA?
Outside of the PSCOA, I work for the Department of Defense. I've been there for about 20 years as an operations research analyst. And I also have Krimmel Economic Consulting, where I perform consulting duties to various unions across PA and the country, Florida as well.
Okay. And have you had the opportunity to be certified as an expert and testify in labor arbitration proceedings?
Yeah, yes, I have.
Okay. You have been asked to perform a specific function for the PSCOA. Can you identify to the arbitrators what you have been asked to do in terms of our presentation today?
Yes. So the first request from the PSCOA was to cost out some contract proposals, both for wage increases and longevity scale changes as well. Those proposals are outlined later in my presentation, where I perform a cost analysis. I was also asked to perform some analysis on some other proposals, missed meals, accidental death benefits, and life insurance. I performed some analysis on that as well compared to inflation, and I'll be presenting that in the last section of the presentation as well.
And without having you go through, because it's fairly well outlined in your presentation, your presentation today will not only outline what you looked at, but the scientific models that you utilize in coming to conclusions. And today you're prepared to present conclusions regarding the Commonwealth's ability to pay regarding the PSCOA's proposals.
Correct. So as part of the cost analysis that I performed, I also performed an ability to pay and comparability analysis for the PSCOA in support of the conclusions of the proposals outlined later.
Okay. Well, Mr. Krimmel, what I'm going to do is turn the floor over to you, and if you wouldn't mind, let us know what you came up with.
Hey, yes, thank you. Good morning. Again, my name is Jeremy Krimmel. I'm a PhD economist that the PSCOA asked me to take a look at the state's finances and also take a look at some of the cost proposals, which I'll be discussing later on in the presentation. I have 141 slides, so I apologize for the lengthy presentation, but I'll do my best to keep it moving as best I possibly can. But if there's any questions at any time, please feel free to interrupt and ask me, and I'll address those questions. Slide 2, this just gives an outline of the presentation. The first thing I'm going to discuss is the U.S. economy, in particular trends and forecasts for the economy, followed by trends and forecasts for the state. A quick economic overview of the state and how they compare economically to some other surrounding states. Section 4 is a very important section. That's the financial position of the state. I'm going to be discussing revenues, expenditures, general fund balance, things of that nature. Section 5 is the PSCOA wage analysis, where I compare the PSCOA to other comparable units, and also compare their wages against the labor market and inflation over the past 10 years. Section 6 are the proposals for the PSCOA, and 7 is just a quick summary. So the first thing that I wanted to talk about in terms of the economy is COVID-19. So without a doubt, COVID-19 pandemic has had a negative impact on the economy. If we look back to last year, in particular Q1 and Q2, the economy contracted significantly, 5% in the first quarter, 31.4% in the second quarter. Now it's important to know why there was such a severe contraction. This recession that we've had is very different than previous recessions. Typically, every recession, ever since World War II and even before that, has been because of inefficiencies in the business cycle. This recession was strictly caused by the governmental shutdowns across the country. And that's why these retractions are so severe, especially in the second quarter. However, moving ahead to the third quarter and fourth quarter of last year, there was a tremendous bounce back. The economy grew by an annualized rate of 33.4% in the third quarter, and then again 4.3% in the fourth quarter. Those gains continue through the first quarter of this year with a very, very high reading of 6.4% in terms of real GDP growth. I wanted to note, too, that that number was far ahead of what economists had projected, both in the last quarter of last year and during the first quarter of this year as well. According to the Federal Reserve Bank of Atlanta, we should recover fully from the pandemic in terms of GDP output by the end of June 21. Matter of fact, we might have already recovered from that, but we won't have that reading until the end of the quarter. I'm going to discuss a little bit more of that later on in the presentation. This slide gives a summary of the quarter-by-quarter contraction in growth during the COVID pandemic. I wanted to point out, too, that the final contraction for calendar year 2020 stands at 3.5%. That's a severe number, but it's not nearly as severe as what was originally projected. The original contraction was 6.5% by the Federal Reserve. We only contracted by 3.5%, and by only I mean in relative terms. The reason why it was such a quick bounce back, I'm going to discuss in the next slides. But what this number shows us is that the pandemic was not nearly as bad as what we had expected and feared in terms of the economic contraction, and the recovery has been much faster than expected. The reason that the economy has been so resilient can really be attributed to these three things. The first was the fiscal stimulus. Trillions of dollars have been injected into the economy by the federal government of the United States. This slide lists a number of those plans. The most relevant, in my opinion, is the last one, which is the American Rescue Plan, where $350 billion were allocated to state and local governments, as well as other programs were funded by that act as well. The Federal Reserve has also injected trillions of dollars into the economy, and I feel like they've been the unsung heroes through the pandemic. Immediately, they came in hard and swift early in the pandemic. They brought interest rates to zero. They purchased mortgage-backed securities, and they really have fueled an economic boom that we're feeling right now, especially in terms of housing purchases and residential construction. With interest rates being at record lows, all-time lows, there's been a buying frenzy, and that's resulted in really what's driven the economy over the past 8-9 months or so. The economy was also in a very good position leading into the recession. This slide gives some economic metrics immediately before the previous recession of 2008, right, which would have been December 2007, and February of 2020, which was immediately before the recession caused by COVID. Every single one of these measures, the economy was in a much better position. Okay, in particular, I wanted to highlight the personal savings rate, which was significantly higher than what it was in December of 2007. This allowed many, many consumers and individuals to weather the storm, so to speak. They had much more savings accumulated, so the impact of losing a job, although was very severe across the country, for many people wasn't nearly as bad as it would have been otherwise. Household debt as a percent of GDP was also much lower, so consumers were not as in debt as they were, and the debt service payments as a percent of disposable income was also less. This slide looks at month-over-month job creation or job loss since the beginning of the last recession. As expected, there was a very sharp decline in jobs during March and April of the recession. There was a sharp bounce back, and we've recovered about 14 million of those jobs so far, about 68%. This slide gives total jobs. As you can see, we've recovered most of those jobs back. Okay, we still have a ways to go. But the Treasury Secretary, Janet Yellen, she's very confident that the economy will recover fully in terms of jobs by the middle of next year, 2022. Slide 13 gives a projection of job growth performed by the Brookings Institute. This looks at the largest metro areas across the country. So this isn't the entire country, but this is the lion's share of jobs represented by the largest metro areas. And as you can see, they expect to be a full recovery by the middle of next year.
Jeremy, with respect to this slide here, are we talking about jobs that are actually available or jobs that are actually being taken? Because as we all know, there seems to be a lot of jobs out there that aren't being sucked up by people.
Yes, these are jobs that are actually taken. Actually, in one of my later slides, I display job openings, and as you'll see, those numbers are very, very high. So this actually represents jobs taken.
Thank you.
Unemployment spiked in April of 2020 as expected, but it also had a very fast recovery and currently stands at 6.1%. Another measure of unemployment is the U6. So the previous measure of unemployment is the U3 measure. That's what the government uses as our headline measure of unemployment. That's the one that the U.S. government says to use in performing most economic analyses. U6 is another measure. It's much broader. And not only does it include those who are unemployed, it also includes individuals that are working part-time for economic reasons. Okay? And as we see, there's been a very, very strong recovery when looking at that unemployment rate as well. And it continues to decline. The U3 ticked up in April by 1/10 of a percentage point, but the U6 continues to decline. So this is further evidence that the labor market is continuing to strengthen. Now, I wanted to discuss the labor market because it's been all over the news, and that the April job creation report came in a little bit below what economists were expecting. So there's been a little bit of a slowdown in job growth. There are a number of reasons for this. The main reason that economists attribute to the slow growth in April is the additional unemployment benefits of $300 a week that are being administered by the federal government through the states. The Bank of America did a report recently, and they tested this hypothesis, and they found that a worker that earns less than $32,000 per year is actually better off staying unemployed during this time and receiving those additional benefits. Okay? So what this has caused is a reluctancy by some individuals to return to the workplace. So the unemployment rate of 6.1% that you see doesn't give the entire picture, an explanation of the labor market. The labor market is actually much stronger than what that unemployment rate indicates. Okay. Once those unemployment benefits completely dissolve, it's expected that 2.5 million workers will re-enter the workforce and look for jobs at that point. I also wanted to note that a number of states have eliminated this benefit altogether. Montana was the first one to lead with that, and I think there's about 11 states so far that have completely eliminated this benefit. Some states are actually giving an incentive, a monetary incentive. They're using this money to pay unemployed workers to return to the labor market. Okay, so I just wanted to bring that note up. Because of that, the labor force participation rate has been a little sluggish. It is off the April lows of last year, but it has been relatively flat since. And on slide 19, these are job openings. So while there are a lot of individuals who are still unemployed and the labor force participation rate has been a little sluggish, we have a record number of job openings currently available. So there are a number of individuals who just haven't returned to the labor market yet for various reasons. And the labor market is much stronger than what unemployment would indicate. One of the consequences of the tighter labor supply has been an acceleration of wages. So from a theoretical standpoint, when the labor supply tightens and there are fewer individuals in the labor pool to select from, employers have to give incentive for employees to either come out of the labor, to re-enter the labor force, or to attract them away from other jobs. And one way to do that is through increased wages. The Q1 report for average hourly earnings, that's one measure of wage growth, stands at 3.8%, which is very, very high. Now, to be fair, some of that reading happened during the course of the pandemic where numbers were a little bit low. Even with that information accounted for, 3.8% is a very, very high growth rate, and economists expect high growth to continue through the end of the year at a minimum. Consumer confidence has been increasing since the bottom of the pandemic. Two things I wanted to note here. There was a small drop-off from the last month. Okay, that happens, and that's nothing to be too concerned about. One of the reasons there was a slight drop-off was inflation expectations. Okay, many individuals don't have a fully true understanding of inflation, and when they hear that term, they automatically think of a negative connotation. That's because many individuals lived through the 70s and 80s. Inflation was high, and it was destructive for the economy. Truth of the matter is we're not in the 70s and 80s right now. Inflation is still very low compared to that time period. And a little bit of inflation is actually a good thing for the economy. The Federal Reserve has done a tremendous job over the past few decades of having inflation controlled. Okay? And there's no reason to believe that that would vanish at this point in time. So while there was a small drop-off in consumer confidence, we should see that pickup resume next month. Financial markets have remained resilient. There was a drop-off early in the pandemic, which was expected, and had a very robust recovery since. Now, the reason why this is so important is because financial markets are forward-looking. The biggest driver of stock prices are future expected corporate profit flows and cash flows. There are other reasons too, like interest rates, but the main driver is future cash flows. So if investors are confident in cash flows, corporate cash flows in the future, stocks will go up. Okay, so this means that investors are very positive about where the economy is headed over the next 6 to 12 months. Okay. Now, there were a number of challenges that COVID presented to the economy. But to everyone's surprise, personal income growth actually increased in 2020. The main reason for this was the stimulus that the federal government provided. Now, for a lot of people who lost their jobs, this provided a cushion. This allowed them to buy food, pay rent if they didn't take advantage of rent delays or mortgage delays. But for a lot of households, this increased their spending. All of a sudden, they have thousands of dollars. So a lot of people went out, they bought TVs, they bought new products. They also undertook residential construction projects and renovations in their house. Okay? Both of those have accelerated. Both retail sales and construction spending has accelerated. And that has a direct impact on state and local financing, whether it be sales tax, whether it be assessment tax for local governments. So as you can see, in 2020, personal income grew actually above trend, per capita personal income. And this actually represents that people were making more because of COVID than they would have otherwise. That's how far above trend it is. Slide 25. This represents April over April retail sales in millions. Okay, as expected, there was a drop-off early in the pandemic, and that's returned very strongly and is well above trend, as well as annualized residential spending, March over March. Next, I wanted to turn to nowcasting. So for those of you that are not familiar, nowcasting is a relatively new statistical technique. I always present this because I think it's a very, very important piece of information. And essentially what it does is it gives a projection for what the economy is doing right now versus what it's going to be doing next quarter or next year. Okay. A number of Federal Reserve banks have incorporated this, and they publish this on their websites. A number of financial institutions are beginning to get into this as well. The Federal Reserve Bank of New York and Atlanta both present economic growth metrics. And the Federal Reserve Bank of Atlanta is probably the most accurate one in terms of GDP growth because that actually tries to mirror the way GDP growth is calculated. The New York Fed's a little bit different. They look at economic growth, but it's a similar measure. Needless to say, both of those numbers are extremely strong right now. Close to 5% economic growth for the Federal Reserve of New York and over 10% for the Federal Reserve Bank of Atlanta. Inflation has also picked up as well. According to the Federal Reserve Bank of Cleveland, inflation is forecast to be 4.5% right now. So both of these indicate that a very, very strong recovery is continuing through this quarter. Slide 28, this gives the blue chip consensus. So the blue chip consensus is a collection of business managers across the country, academics. I'm not sure how many members do it, but it's probably a few hundred. And they all give their best guess, essentially their own nowcast as to what's happening in the economy. That blue range gives the top 10 and the bottom 10 forecasts. It gives a consensus forecast. Essentially, every single person involved in this blue chip consensus is forecasting very, very strong growth at this point in time. The median stands at 9%. Very strong number. Moving ahead, I wanted to discuss where the economy is headed. So I'm looking at the Survey of Professional Forecasters. This is a very well-respected forecast there are about 40 professional forecasters that every quarter give their opinion as to where the economy is headed. And they range from members of academia, bank managers, financial fund managers, and it's about 40, sometimes a little bit more, sometimes a little bit less. It's available from the Federal Reserve Bank of Philadelphia. Now, I presented two forecasts. First, the Q1 forecast, and then the Q2 forecast. Okay. The first forecast is from Q1, is on slide 31. And as you can see, they're calling for very, very robust growth through 2024. Unemployment is expected to decline and reach full employment by 2023. And inflation is expected to be about 2%, which is higher than the last 10 years by far. Okay. Slide 32 gives the quarter-by-quarter estimated growth. And these forecasts were given in February of this year. Okay, so these are previous numbers. Moving ahead to slide 34, this is the beginning of the Q2 forecast. I just wanted to highlight two of the things mentioned on the front page of the report. First, the highlight is a faster pace of economic rebound with stronger labor markets. So even though there was an uptick in unemployment this previous month, labor markets are still strong. And I wanted to highlight the next sentence, the first sentence. The U.S. economy looks stronger now than it did 3 months ago. On slide 35, we actually see those forecasts, and they've increased in every single category. Economic growth for 2021 increased from 4.5% to 6.3%, and that'll likely increase for the next forecast given in the third quarter. Unemployment rate looks strong as well, and also improved from the previous forecast. It's also worth noting that inflation jumped from 2.2% in 2021 to 3.0% in 2021. Slide 36 gives a quarter-by-quarter comparison between the two surveys. The Q1 projection given in the first quarter was for 3.2%. The actual reading was 6.3%, so almost double what was projected. Every single quarter after that point in time has been revised up as well. So not only is the economy getting stronger, it's accelerating because the forecasters continue to increase their projections. Slide 37 is just another forecast. This is by the Federal Reserve Board of Governors. They too are increasing their forecasts. This compares the December projections to the most recent projections in March. And for 2021, they call for an increase from 4.2% to 6.5%, very similar to the survey professional forecasters.
Jeremy, let me ask you about this. You were actually asked by the PSCOA to start doing this analysis prior to the last contract when we were in the midst of COVID.
That is correct.
And you'd agree with me that these numbers, the forecasts back then, certainly didn't look this good.
No, they did not.
When we look at December projections versus new forecasts, does that have to do with new information regarding forecasting, or does it have to do with what's actually happening in the world over that same period of time?
It has to do with what's happening in the world over that period of time.
Okay, and so when we look retroactively over the past year, has the world come back better than what has been forecasted?
It's come back much better than what was forecasted, yes.
Okay, thank you.
Moving on to slide 38, I wanted to talk a little bit about inflation and the impact that that has on wages for the labor market. So wages, economic growth, and inflation, these three elements, they tend to move together over time. As economists, we don't know if there's a causal relationship between one and the other two or between all three, but we know that they move together over time. Since 2012, the Federal Reserve has had an official mandate or official target to keep inflation at 2%. However, recent guidelines by the Federal Reserve Board of Governors, they've indicated they want to let inflation run above 2% for a period of time, and they use period of time very, very loosely. But what that means is that we should start seeing inflation creep up, not only right now, but also in the forthcoming months and even years as well. And inflation should run above that 2% target. Okay. They're calling it a makeup policy, and because wages. Okay. This next slide, in slide 40, this presents the survey of professional forecasters, their long-term inflation outlook. And I included some previous surveys because I wanted to show the progression of expectations over time. So in the second half of last year, the forecasters had a 1.9% outlook for inflation, and that's over the next 5 years, and that's increased to 2.4%. That's a very significant jump, especially in the world of economics. The 10-year outlook has risen dramatically as well, from just over 2% to 2.3% over the next 10 years. So not only will inflation most likely be higher this year, that trend should continue into the foreseeable future as well. Slide 41 gives inflation and core inflation since the last recession. And as we can see, there was a big uptick by that purple line in year-over-year inflation. And the most recent reading, as of April, stands at 4.2%, the highest reading since 2008. Now, to be fair, in April of last year, we did see a lower level of the CPI in general. We had lower fuel prices, and that's reflected in this as well. But even after we remove fuel and energy, fuel, energy, and food expenses, and we look at the core inflation level, that stands at 3%, okay, the highest over this entire span. So inflation is moving, it is on the rise, and it should be considered when moving forward for anybody looking for a new contract. Okay, next I want to talk about the PA economy. It's a very large economy. It's the 6th largest in the United States. It's also the 19th largest in the world. The state has done a tremendous job of deindustrializing over the last few decades. Back in the 70s, there was a lot of output from manufacturing, and it's shifted to mostly a service-based economy at this point. And the positive result of that is that it's a much less volatile economy compared to the national economy. As a matter of fact, Bloomberg ranks Pennsylvania as the most economically diverse out of all the states. And one of the reasons why this is very, very important is because not only does it make the economy at the state level more stable, but it reduces the spillover effect if there's poor performance in one economy in particular. Okay. However, that logic actually flipped during the pandemic. And as you see on the left chart, growth decayed at a little higher rate than it did for the nation during the pandemic, and it expanded at a little bit faster pace in Q3. The reason why it experienced greater volatility during this period is because of the severe governmental shutdown by the government. It's well known that PA had one of the more severe shutdowns, and I'm not saying that was the right or wrong decision. I'm just stating the fact that it was more severe, and it continues to be a little bit more severe as well. And it definitely had an impact on the state's economy. When we look at unemployment, it pretty much mirrored the national unemployment rate. It has flattened off a little bit, but again, part of that is because of the governmental shutdown. Okay. Slide 46 is total jobs at the state level, and it's pretty much followed the national pattern. About 63% of the jobs have been recovered that were lost since the pandemic started. The labor force participation rate in slide 47, it has stabilized. It still remains fairly low, but once those additional unemployment benefits expire later in the year, we should see an increase in the labor force participation rate. Home prices have done very well across the country, and this is the FHFA index. It's essentially an index for home prices. This is at the state level. And we can see that in the latter half of last year, there was a surge in home prices. And this affects the state finances in terms of the realty transfer tax. This is a positive effect with the state. Slide 49. Now this is a projection that's provided in the state budget, the state executive budget. This was published in FY 21-22 February. It's February this year. The numbers were very similar to the mid-year brief given by the governor late last year in November, December timeframe. I also included on that same slide is not only the state outlook, but the national outlook as well. So at the time this was performed, the national outlook was expected to be 3% for this year and 3.3% for the state. Clearly that number for the national economy has increased. So that number for the state of 3.3% should also be higher as well. And the same carries for 2022 and 2023 as well. At the time of this forecast as well, the additional stimulus from the federal government in terms of direct payments to household had not occurred yet. It was still being debated amongst Congress. So there is a reduction of negative 2.2% in personal income in 2021. That's the reason why there's a negative. Okay, it's because the state did not expect that stimulus to come at that point, so there was a reduction in income from last year. Okay, that number will most likely be positive this year, and the number for 2022, 3.2%, will probably be revised down a little bit. Slide 50 gives a more recent projection. This is done by TD Bank. They provide both state-level projections and national-level projections, and I wanted to have the two just so you can see the panel can see the comparison. They have the U.S. economy growing at 5.7%, and the state economy growing at 5.7% as well, much higher than the 3.3% that was used by the state budget given in February. The growth is expected to be higher for 2022 as well, for the state and the national levels. And most likely those numbers will be revised up again. Okay. Next section, on to the economic overview of the state. Okay. And what I wanted to do is I wanted to compare Pennsylvania to a number of local economies listed on this page. These are bordering economies. They include New York, New Jersey, Delaware, Maryland, and Ohio. All of these economies are in the Northeast. Ohio is a little bit more in the Midwest, but it's a similar economy to the state of Pennsylvania. When we look at the median household income, Pennsylvania does rank a little bit below the other states, pretty comparable to the United States, the national level at large. Same with per capita income on slide 55, and earnings for male full-time year-round workers. Now, even though PA has a low income level for households relative to these other states, it generates more in tax revenue in their general fund and across the board through highway tolls and things of that nature. So even though they have a low income, it doesn't inhibit their ability to raise taxes and generate revenue for the general fund. As a matter of fact, Pennsylvania actually has a very low tax burden on their individuals. This information is given by World Population Review, and it looks at the majority of taxes paid by individuals. Okay, so that includes property tax, it includes sales and excise tax, and income tax. Now, granted, at the Pennsylvania level, property tax does not go to the state, it goes to the local and county governments. But relatively speaking, when all those are combined, a typical PA resident has a low tax burden. Okay? And this implies that there is room to increase taxes if need be. Now, I'm not advocating for that by any means. I'm just stating a fact that there is room, and it wouldn't hurt the typical Pennsylvania resident that much. Other states are paying much higher tax rates. It also has a very, very good tax structure. This information is given by the Tax Foundation. This includes all the taxes that I originally mentioned, plus the corporate tax. And it accumulates all of those tax rates and puts them into a tax system score. It's rather proprietary, it's pretty complex, so I'm not going to get into how that's done. But a lower score implies a better tax structure, and PA has one of the better tax structures of these comparable states. And this is a very desirable attribute. Okay, next is on to the financial position of the state. Okay. I wanted to look at the past 10 fiscal years, and despite the effects of COVID, okay, the state's economy and their financial balance sheet remains relatively strong. Okay, and if we look at the entire trend over the past 10 years, it can be characterized by very strong revenues with stable growth, very stable revenue streams, which is a very desirable attribute, and it maintains a very favorable bond rating. Okay? And I wanted to note that despite the effects of COVID-19 on the economy, the state's finances have stabilized, and they've improved much faster than anticipated. And I will go through that information in these next few slides. Pretty much every state experienced a significant amount of stress during the pandemic. Wells Fargo did a study, and they found the contractions pretty much across the board. But they also noted that pretty much in every case, the contractions were less than what were feared and the recovery was much better than expected. And what happened was there was much better fiscal performance across states across the board, and that's certainly true with Pennsylvania. And what they contribute this performance to is pretty much what I've already gone over. I'm going to highlight each one of these. A stronger economic recovery, a shift in consumption towards goods and away from services. Because people were home, they were not purchasing services as much, and they were purchasing goods. Goods are more subject to sales tax, and state revenues have been positively impacted by the additional sales tax that they've collected. There's been a very robust residential housing market. Personal income has been resilient, and there's also been a rapid rebound in stock prices. And this has also been strong for pension funds as well and personal savings accounts. Slide 64 gives the net position since FY 17-18. There was an increase during FY 18-19, and then as expected, there was a decline in 19-20. But the state's net position remains above that of 17-18. Okay. Now, there were some pretty significant changes to the way net position was calculated over the past couple of years. Okay. In particular, GASB mandate number 75 and 68 mandated that OPEB liabilities and net pension liabilities are included in the net position. So what I wanted to do was I wanted to remove those numbers and look at the trend back to 10-11. And I call it the modified net position. So it just has those two elements removed. And as you can see, the state's position has improved significantly since 13-14. Okay. As I said before, Pennsylvania has a very, very low volatility in terms of revenue. Pew Charitable Trust does a comparison of states every year, looks at the revenue volatilities. Pennsylvania is one of the lowest, second lowest in the comparable group. And the advantage that this presents is that revenues are much easier to forecast, and it also allows whatever governmental level to hold less in reserves. Because when revenues are stable, you don't need as much in the reserve balance for your normal day-to-day financial operations. Slide 68 gives revenues over the past decade. And I wanted to note that this number here is from the PA CAFR report. So this includes not only taxes, it also includes grants from the federal government. The budget report doesn't provide that, and I try to note that as best as I can throughout the presentation. Okay. Slide 69 gives general fund tax revenues since 10-11. They performed quite well. And since 2013, 2014, when the economy started to really accelerate and the state's financial position started to improve, taxes grew by a rate of around 4% per year up to 18-19. Now, 19-20, you see a big drop-off. Part of that is because of COVID, and part of that is because there was a delay in the tax collections in personal income tax and corporate net income tax. Those collections were delayed until FY 2021. However, I'm just going to go back one slide. Those particular revenues are included in the GASB procedures that are used in the CAFR reports. So there was about $1.8 billion of taxes that was transferred from last fiscal year to this fiscal year. In terms of GASB and the CAFR report, they are considered 19-20 revenues because they were collected in a relatively short amount of time after the start of the fiscal year. They're considered receivables. In the budget reports, they're not. They're considered as 2021 revenues. So I just wanted to make that clear moving forward as to what revenue is counted and when. And if anybody has any questions, I'll be more than happy to address those. Slide 71, we've seen increases in all the major tax revenues over the last decade. Slide 72, this looks at total revenues from the CAFR report. And since 13-14, they've grown at a rate of 6.1% per year, faster than expenditures of 5.9%. On to slide 73. It's not surprising that COVID had a negative impact on the state's balance sheet. There was a drop of around $2.4 million in the general fund balance. But I also wanted to note that the drop was not nearly as big as it was after the Great Recession of 07-08. where it dropped by $2.5 billion. Okay. Next, I wanted to discuss GFOA, the Government Finance Officers Association. They have a recommendation that state and local governments, county governments, hold around 70% of expenditures or revenues as unrestricted reserves. However, as a footnote in that report, they also state that larger governments, such as states, can hold significantly lower levels. Now, they don't actually give a number as to what should be held by states. It's up to each individual state. Some will be a little bit higher if they have more volatile revenue streams. Some could be a little bit lower if they're more stable. In Pennsylvania's case, they have a very stable revenue stream. So they have the ability to hold much less in terms of reserves. They don't need to hold that 17%. On to slide 75. These are the unrestricted reserves. The yellow bars are the actual unrestricted reserves from the CAFR reports. Currently stands in around negative $1.7 billion deficit. Okay? And as expected, the reserve levels as a percent of expenditures have dropped as well. But it's not the first time that the state had a negative balance like this. 08, 09, 9 and 10, there were negative balances, as well as 13, 14, 15, 16, and 16, 17. So this shouldn't be used as an alarm per se. In terms of assets and liabilities, it's better to look at both of these combined. So this looks at general fund assets and general fund liabilities. It takes the ratio. Okay? As long as that ratio is above 1, the state is in a good financial position. Right? Over the past decade, that number has grown from 1.18 to 1.36 right before the pandemic. Dropped to 1.1 during the pandemic, but that's still above 1. That's a healthy ratio. It's been stable, and that's a good position to be in. Slide 78. Debt levels have come down across the board for Pennsylvania. They've declined to $11.5 billion in FY 1920. And it's a 30% reduction since its peak. Also, the percent of actual taxes, or the percent of debt as a percent of actual tax revenues has also declined as well. In terms of debt capacity, general obligation, non-electoral debt capacity, the state is only at 13.3% of its limit. It can raise over $62 billion at any time and still be within the legal limits set by state law. So they have a lot of room to expand their debt capacity if they need to, or their debt levels if they need to. One very important note that I wanted to mention on slide 80 is that even though the state had troubles during the pandemic, their bond rating remained the same throughout. And that's very, very important, because this means that the state is able to meet the demands of their investors, essentially their debt service payments. If there was any kind of deterioration whatsoever in their ability to meet those obligations, it would have been reflected in these reports, and there would have been a downgrade. There wasn't a downgrade, so both Moody's, S&P, and Fitch maintained their ratings. That's a very, very positive element of their financial position. Slide 81 just gives what those ratings mean. It means they have a very strong to meet their obligations and a strong capacity to meet their obligations. Slide 82 highlights some of the notes of those reports. I'm not going to read through every single one of these, but they all highlight the very diverse and large economic base that the state has as a stabilization point for their bond ratings. The next slide starts the analysis of their FY 2021 performance. Okay, now no doubt about it, and I admit this, that forecasting has become very difficult during the pandemic. It's starting to become easier now that the economy has become more stable. But I wanted to note that the state has done very, very well in terms of general fund revenues this year. As a matter of fact, they've exceeded projections, and the projections have been revised up by both the state and the Independent Fiscal Office. Slide 84 gives total general fund revenues from the budgetary method. The left chart looks at the state's projections in November and then again in February for FY 2021 final year revenue numbers. They increased their projection by $500 million, and the IFO increased their projection by $1.9 billion. That's a significant increase in their projections. Slide 85 looks at cumulative projections versus the cumulative actuals. These projections were performed by the IFO back in June. And through April, the state was $2.6 billion ahead of projections that the IFO gave early in the pandemic. So they performed much better than expected to date. I also wanted to note that in April, there was a transfer in payments, mostly because of the delay in the tax filings from April to personal tax filings from April to May. So there was a slight reduction in terms of the cumulative difference in that month. And that's expected to alleviate itself next month. So that number that dotted line should jump back up again in May. Slide 86 looks at the revised projections for the remainder of the year, January through April. And when we look at those numbers, the general fund actual collections are $270 million ahead of the revised projections. Again, that's very significant. And that also includes the transfer of personal income tax from April to May. And the IFO said that those numbers will resolve themselves in May. So we'll see that dotted line jump up again, closer to $600 million by the end of this month. Slide 87 looks at the major tax drivers. They've all exceeded projections. And again, personal income tax, those actual numbers will be higher in May versus the projections because of the transfer. I also wanted to include the realty transfer tax because real estate has been very, very strong this year. Home prices are up. So the state has collected more in the realty transfer tax because of the strong housing market. Okay. The state also has some proposals looking ahead in terms of changing their tax base. In particular, they're looking to change the corporate net income tax. They're switching from the current system to a mandatory combined reporting, meaning that if a corporation is headquartered in Pennsylvania and they have operations in another state, say New Jersey, the profits from their operations in New Jersey would no longer go to corporate tax in New Jersey. It would go to corporate tax in Pennsylvania. A number of states have moved to this, and they've all been very successful in expanding the economic base by which they collect their corporate tax from. That's going to be combined with a reduction in the corporate rate. It's proposed to be effective January 2020, and it's expected to have a $200 million impact, positive impact, on the general fund in FY 21-22. It's also been proposed to change the personal income tax from the current rate of 3.07% increase to 4.49%. And again, the state has the capacity to do that because it has a low tax burden on the residents. This is expected to become effective July 21st. And there's also some other filings too. Certain individuals, the filing cap for low-income individuals has been raised. So there's a number of other changes as well. But it's expected to have a positive impact next year of around $3 billion. Now, these haven't been set in stone yet. These are just proposals. I wanted to make that clear. Okay. They've also made proposals to change the minimum wage. Okay, they're going to step up from up to $12 an hour and then proceed to $15 an hour beyond this year. Okay. It's expected to generate an additional $116 million over the next 5 years. Okay, not only through greater personal income tax, people earn more, they pay more in tax, but because they earn more, they buy more, and they'll contribute to the sales and use tax as well. But again, this hasn't been finalized yet. This is just a proposal. Slide 90 gives general fund projections for total taxes. They're expected to increase by 4.1% per year, and these include the proposals that the state gave back in February. Okay. Now, slide 91. I wanted to take a snippet from the executive budget given by the state back in February, and these projections were most likely made early in the year, probably January. If we look at GDP growth for 2021, their projection that they use in their budget for the next fiscal year stands at 4.3% and then 3.6% for 2022. However, on slide 92, if we look at the most recent survey by the Survey of Professional Forecasters, GDP growth is expected to be much higher at 6.3%. So if economic growth is higher than what was originally projected, we should see additional revenue growth for the general fund because of better economic conditions moving forward. And since the 2022 forecast is higher with the most recent forecast, revenues should increase in that year as well. Okay. On to slide 94. This is a projection of the personal income tax over the next 5 years. Slide 95 is a projection for the sales and use tax. And slide 96 is a projection for the corporate net income tax. Okay. And this is with the proposed tax changes that the governor gave back in February. Okay. Now, one of the things that makes this very, very uncertain is how the tax base is going to change. Okay. Certainly, there should be an increase in revenues right off the bat because corporate taxes that are currently being paid in other states are now going to be paid in Pennsylvania. But it's also unclear as to how many new corporations will locate to Pennsylvania because of the more favorable tax structure. These projections are given by the state, okay? And you'll notice that the corporate net income tax is expected to decline after 2022-23. Okay, now granted, it's very difficult to determine how that tax base is going to expand over that time period, and they expect it to reduce for some reason. Okay. If you look at slide 97, okay, it's very unlikely that would be passed in its current form because it would reduce revenues, and I can't see any state actually approving a change to the tax structure if it's going to reduce revenues. Hey, that is unless the decline was offset somewhere else, or if the taxing authority could absorb the loss. So there must be some kind of reason. So if that tax change does go through, it most likely will be a positive benefit over the long term. I can't imagine the state making that change and then expecting a negative impact on finances. Slide 98 gives the general fund balance projection over the next few fiscal years. As you can see, there's expected to be a very strong bounce back in FY 2021. Okay, part of that is because of $1.8 billion that was transferred in the delayed tax collections from last year to this year. Okay. I also wanted to include the funds that are earmarked to be transferred to the Budget Stabilization Transfer Fund. The reason why is because even though the state classifies them in a different fund, okay, the GAAP procedures, or GASB, the Government Accounting Standards Board, they say to use those rainy day funds as part of the general fund unrestricted reserves. So I want to include them in there just so you can see. I wanted to note on slide 99 that those projections don't include the general fund revenues that are excess in terms of projections for FY 2021 and 21-22. It doesn't include any increased economic performance, the additional revenues from that as well. It also doesn't include the funds from the American Rescue Plan. So back in February, it was authorized by Congress that $350 billion would be directed to state and local governments. Pennsylvania is set to receive $7.3 billion from the Coronavirus State and Local Fiscal Fund Recovery Fund, and another close to $300 million from the Capital Projects Fund affiliated with the coronavirus. Now that's separate from the funds that are going straight to local governments. They're getting $6.4 billion directly. It's very broad as to how those funds can be used. Okay, and highlighted in the Act itself are these 2 points that I wanted to highlight. Number one is for premium pay to workers performing essential work, whether it be police officers, firefighters, correctional officers. It also can be used to offset a reduction in revenue because of the pandemic. The only restrictions is that it can't be used to offset pension fund losses or be contributed to pension funds, and it can't be used to cut taxes. Okay. It's been a little unclear because there's so much leeway as to how those funds can be used. It was asked to Secretary Yellen, the Treasury Secretary, a few weeks ago, and she said that there's going to be a significant amount of leeway as to how states can use those funds. Next slide. The PSCOA wage analysis. Okay. The first slide in this collection, well, really slide 105, is the PSCOA compared to other units in the comparable states. Okay. The majority of the members of the PSCOA are part of the CO35 classification. So each of the other states has their equivalent classification used for their correctional officers as well. Okay. I wanted to highlight that early in the PSCOA member career, okay, their wages, base pay, is below the median considerably. Starts off by about 7.7% and remains low through about the 5th year of service. Right? In the middle of a PSCOA member's career, right, it does improve and it becomes a little bit above the median. Then toward the tail end of the career, around the 26th year and after, it's about the median. So it's not the highest by any means, but it's also not the lowest through the majority of the career. Slide 106 is just a graphical representation. Okay. Slide 107, I wanted to come back to that point of how the PSCOA ranks early in a member's career. It is significantly below the median. These are when recruits are hired early in their career, obviously. So this has an impact on recruiting. Slide 108, I wanted to highlight a study that was performed by the American Correctional Association. Now, the study was performed back in 2004, but what they found holds true today. And I'm not going to read this passage, but I am going to read the first line, because I think it applies to our case today. And in their analysis, they find that the study respondents noted that inadequate pay and benefits, burdensome hours and shift work, a shortage of qualified applicants, and undesirable location of correctional facilities are factors that render recruiting difficult. So the fact that the PSCOA has lower pay compared to other units in the same economy, essentially, state and regional economy, is having an impact on recruiting, and it's noted by the American Correctional Association. Okay. On slide 110, I took a look at the PSCOA pay and compared it against inflation and the labor market. Slide 111 gives effective base wages in current dollars over the past decade. Now, the reason why I say effective is because in multiple years, there were increases in pay that didn't occur on July 1st. Some were in October, some were in January. The effective pay looks at the weighted average of that particular year. Now, the numbers on the screen at the bottom, the compound annual growth rate stands around 2.1%. These numbers are a little different than the numbers you might see in your binders. Okay, I think in the binders it might say 1.8%. The reason for the difference is that I wanted to relook at the numbers last night, and I found a flaw, so I wanted to update that, and I corrected it for everybody to see. So I'm more than happy to send updated slides to everybody, should that be. But that number should be around 2.1% across the board at the bottom of that chart.
And we will identify approximately 4 slides that I can provide everyone with updated copies tomorrow morning.
Yes. Okay. Slide 112. This is the effective base wage in FY 10-11 dollars. I adjusted it for inflation at the national CPIU level. And again, this was a slide that I had to correct because I corrected the previous slide. Okay. So these are inflation-adjusted wages. Over the course of time, over the past 10 years, the PSCOA wages, real wages adjusted for inflation, increased by a rate of around 0.35% per year on average. When looking at regional inflation, they increased by around 0.76% per year. And again, this is one of those slides that were corrected last night. Now, wages typically tend to increase faster than inflation. This is perfectly normal. And the reason why is because wage growth is ultimately determined by the labor market. It's a big misconception that wages are determined by the CPI or inflation alone. They are determined by supply and demand in the labor market. And I wanted to point that out before I proceed with my analysis. As the economy expands, it's perfectly normal for wages to grow faster than inflation. The only time that it doesn't happen is during times of recession. Okay. We saw it in 2008. However, we didn't really see it this year, okay, because it was a different economy, a different type of recession altogether. This next slide looks at the average PA wage of a typical resident since FY 10-11. to the most recent observation of FY 1920. Okay, on average, a typical resident's wages have increased by 2.7% per year. Regional inflation, and by regional inflation, I use the Philadelphia measure for the BLS. That's the most local level I could find. That grew at around 1.2% per year, and the national CPIU grew around 1.7% per year. Okay. I also wanted to note that PA wage growth has exceeded inflation by 1.5% per year, and national inflation by 1.0% per year. So it's typically normal, perfectly normal for the labor market to move ahead of inflation over time. When we look at the PSCOA, those numbers come in a little bit light. Okay. They've exceeded the regional inflation levels by only 0.76% per year, and the national levels by 0.35% per year. Okay, PA wages exceeded those levels considerably. Slide 117 gives a measurement of what an officer made in FY 10-11. Okay, the black line is what they actually make as per the contract. And the other color lines are that same rate of $40,000 in that year had they grown by various levels of inflation or wage growth. All right, now there's three measures of wage growth that I used. There's no one perfect score. Economists use a plethora of different wages. These are the most popular ones that are out there. They're average hourly earnings and wage tracker produced by the Federal Reserve Bank of Atlanta. Wage tracker is probably the most accurate, but it's not given at the regional levels. Okay? Wage tracker looks at continuously employed individuals over a certain span of time and looks at that wage growth. Average hourly earnings looks at all workers, part-time, full-time, but it also includes seasonal employees that might not be employed continuously for 12 months. And typically what happens is average hourly earnings, that growth rate tends to be below wage tracker, just because of that reason. But I think it's important to be transparent by all measures that I can put in there. Either way you look at it, the PSCOA has not kept up with the labor market. And when we look at wage tracker, they've fallen by about $5,000 per year behind wage tracker, what they should be, and only slightly ahead of inflation. Slide 118, I wanted to note that challenging work, work that police officers, correctional officers have, it's a risky job. And from an economic standpoint, when more risks are inherent in the job, employees need to be compensated for that. They need to be compensated for their additional skills and the challenges that they face at the job every single day. If they're not compensated properly for that risk, they will seek work somewhere else, either with another employer or in a different profession altogether. So it's important that that premium pay ratio, the difference between what the market is paying and what the PSCOA or whatever correctional officer unit we're looking at makes, it's important that that premium pay stays constant over time or it increases if the risk increase. Okay. I wanted to research a little bit about correctional officers, in particular some of the challenges that they face. And the RAND Corporation recently, I believe it was 2017, performed a report on some of the challenges that correctional officers face. It's a very comprehensive study. But I wanted to highlight some of the challenges. Internally, inherently dangerous work. That requires a risk premium. Extraordinary stressors that can negatively impact staff well-being. Overwhelming workloads with limited resources. All these represent risks and challenges that the PSCOA and correctional officers in general need to be compensated for. There's also external challenges as well. Now, at the time of the report, employment was at record lows, and I wanted to keep that in there to be transparent. Even though unemployment is a little higher right now, I wanted to keep that in there because the labor market right now is much stronger than what unemployment indicates. There are a number of record level of job openings that we already went over. So it's actually very easy for a correctional officer to leave his or her unit and obtain a job somewhere else right now if they chose to. So that's another challenge that correctional officers face, not only from internally but external factors as well. The premium pay for the PSCOA has deteriorated over time. Okay? And that implies that the PSCOA members are not being compensated for those risks today that they were 10 years ago. On slide 122, I graphed those comparisons over time. The premium pay ratio for a new hire through multiple years of service through a member's career. The blue bar represents the premium pay ratio in FY 10-11, and the gold bar represents the premium pay ratio in FY 19-20. And as you can see, that ratio declined over time. And again, 19-20 is the most recent data I have for the average wages across the board for the state. Okay. Slide 123, there was a recent report that was written. The author was named Song. It's given by the National Bureau of Economic Research. It's available on their website. There were also other authors as well. Too many to list here, so I just kept this to the first, usually the most prevalent one in the study. During the year, we have a new risk associated with any kind of essential work, but especially with correctional officers that have to go to the job every single day. They have to work inside. And unfortunately, that's where COVID is transmitted much more easily than other workers who either can work from home or who work outside. But what they found was that an essential worker was 55% more likely to be infected with COVID-19 than a non-essential worker. And these essential workers are people who went to work every single day. That's a very significant probability. That's an additional risk that the PSCOA members face. And according to economics, they have to be compensated for that risk.
Jeremy, if I understand this though, notwithstanding COVID, we're already looking at a class of people that are deserving of some type of increased risk pay. But then when you take that into context of the American Rescue Plan, that's exactly what those monies were for, was to compensate these folks back here who then had an additional risk because of COVID.
That is correct. That is specifically mentioned in the Act itself. Slide 124, this looks at PSCOA voluntary resignation rates over the past decade. This is from PA Work Stats. I couldn't find data prior to 11-12, so that's why the data starts there. But as you can see, resignation rates have essentially doubled between FY11 to FY 19-20. And I wanted to note, too, that the FY 18-19 numbers were also high as well. So while COVID has a factor in resignation rates and their increase, it's not the only factor as well. Resignation rates were also high before then. And I also wanted to note that resignation rates were very high in 19-20 during a period of great economic uncertainty. Okay. The second to last section now are the proposals that I costed out. In particular, I look at wages and longevity, reimbursement for missed meals, and life insurance and accidental death benefits. Okay. Slide 127, these are what I'm looking at. So for wages, a 4% increase each fiscal year over the life of the contract, and an increase in the longevity scale from 20 to 38 years. Slide 128, these are the cost estimates for the salary increase proposals. These do not include the different longevity scale. I wanted to separate these as best I possibly could to give a clear indication to the panel when deciding a final award. Okay. The cost estimates include retirements and separations, and I'll explain how I come up with those projections in a moment. It includes annual step and longevity progression, and again, the current longevity scale. So how do I determine if a person retires or not? It's very difficult to determine. I didn't want to take an assumption that, the highest paid employees, usually the older employees, those employees who have been there 25, 30 years would automatically retire, because they don't always retire. So I try to take a very, very economic approach, and I ran essentially a quasi-simulation. Okay? So to each member of the bargaining unit, okay, they were assigned a random number, and they retired based upon the probability of retiring and the comparison between that probability and the actual random number that was generated. Okay. The reason why I say quasi-simulation is because you really should run it about 10,000 times, but because my programming skills in MATLAB are a little limited, I ran it in Excel a number of times the best I could. And these are the averages that I came up with. These were very, very reasonable estimates based upon what's happened in recent history. And as you can see, the retirements are estimated to be around 500 per year, a little bit higher than that in subsequent years. And separations to be around the 600 mark, a little bit lower. Okay. One of the benefits of performing a quasi-simulation like this is that it's perfectly random, so I didn't make any judgments as to who's retiring, who's not retiring. It's purely random. And it also fluctuates from year to year. So if, for example, in a particular year, there were a low number of retirements, just because that's the way the probability worked itself out to be, because that next year there's a larger number in that pool, more people retire because of the way the numbers work. And then the next year, it fluctuates down again. So we have that oscillation from year to year. Okay, having said that, the proposal was for an increase of 4% per year. And when we look at the line below that, the projected increase, it's far below that, coming in at 2.4%, an increase of 1.9%, and then an increase of 2.3%. And the total estimates for wages and longevity are given on the top line in the salaries. The baseline number is what I used to estimate the cost for 2021. Okay, there had to be some kind of baseline. That number might be a little bit higher, might be a little bit lower, depending on the final numbers who retired by the end of the year. It's impossible to know for sure. So that was where the baseline starts from. Okay, next slide. This is the change in longevity. What I wanted to do was I wanted to provide a maximum cost. So I didn't want to assume people were retiring and kind of obscure that. So I assumed that there were no retirements or separations during this time. I looked at the current scale, the way the plan is currently set up, and I looked at the change from 20 to 33 years. So I took all the members in that particular group who have been with the PSCOA, have been correctional officers for 28 years or more. I calculated what they would have made in longevity each one of those years under the current plan, and then what they would make with the proposed revised plan. And I took the difference of the two. So in FY22, there's a difference of only $217,000. Increases to a change of $340,000 next fiscal year, and then $500,000 that year. And it should cap out at that year because those employees who currently wouldn't benefit from that change the next fiscal year would by the next. There's some of that overlap. So that number should flatten out by that point in time. Slide 130 looks at missed meals. It's been the same since 94-95 at $8 per meal. When that's adjusted for inflation at the national level, that's worth $4.60 in $94.95. Slide 131, if that $8 increased at the same rate of inflation, it would be worth $13.92 today. Almost double.
So, Jeremy, are you suggesting we should increase or change our proposal instead of 12 to almost 14 then?
Well, I can't say what it should be changed to, but according to the laws of economics, it's a very, very reasonable request.
Understood.
Slide 132 is the same analysis for life insurance. It's remained $40,000 since 94-95. Today, that's worth around $23,000. Not quite half as much, but close to it. If that was increasing at the same rate of inflation, that number would be around $70,000 today. Slide 34. Accidental death benefit has not changed. It's been $20,000 since 94-95. Adjusted for inflation, that's worth $11,500 today. Had it increased at the same rate of inflation, that would be worth $35,000. And finally, the summary. So there's no denying the fact that the recession has been a draw on the economy. It was caused by COVID. But the contraction was very, very brief, and the recovery has been very, very strong. All right? Professional forecasters have continued to increase their forecasts for the economy, and we should have a full economic recovery in terms of real GDP by the end of June of this year. We may have already hit that point, as a matter of fact, but we won't know for sure until later on. Economic growth and inflation are expected to be strong through 2024. The PA economy has lagged the U.S., but for the most part has recovered at a similar pace. The state generates a relatively high level of tax revenues and has a low level of tax burden. The general fund revenues this year have outpaced projections significantly. And as of April, they're $2.6 billion ahead of projections that were made in June. Okay, and again, that number doesn't include a number of personal income tax filings that were delayed to May of this year. So that $2.6 billion is probably closer to $3 billion. Okay. Despite COVID, PA has maintained a very favorable bond rating. PSCOA wages have not kept pace with the labor market. Premium pay has deteriorated since FY 10-11. And multiple PSCOA benefits have not changed since 94-95, and they've declined considerably when adjusted for inflation. Thank you, and that concludes the presentation. I'll be happy to address any questions anyone may have.
Pat, do you need a break before we go on a cross-exam?
I don't need a lengthy break, but I would ask for like 10 minutes or so.
Yeah, let's take a 10-minute break. Please come back within 10 minutes if you can. It's 11:15 now, so about 11:05, let's reconvene. Okay, if we could take our seats now, and Pat, I'll turn it over to you.
All right, thank you, Mr. Arbitrator. I'm going to begin asking, and Jeremy, you don't mind if I call you Jeremy because we go way back. Is that okay?
No, that's fine.
Or I will call you whatever you want to be called.
Jeremy is just fine.
Okay. Just to talk about our history, I think I may have been some of your original testimony. I think I may have been there because I've been about, let me go through real quick. You've been doing this for how many years, doing the testimony in Act 111s or Act 195s? How long have you been doing this?
2018 was my first testimony.
Okay.
Analysis 2017.
Okay, and I remember being on the other side back in 2018, and multiple times you testified, I think.
I'm not sure if we...
East Whiteland, West Whiteland.
That may have been 2019.
Okay,
but
okay.
Yes.
So maybe when you first started off, I wasn't there, but soon thereafter. And we've met each other in multiple of these cases, correct?
Yes.
Okay. And these have been police and fire cases where I've encountered you, and you've presented economic testimony, and I've cross-examined you. Is this the first corrections case you've done?
No.
What other correction case have you done?
I did the Allegheny County Correctional Officers at the end of 2019.
At the end of 2019. So you've done that and this case. This is the second corrections case you've done?
Yes.
You've done a county?
Yes.
Have you done any, this is the first state corrections case you've done?
Correct, yes.
Okay. And this is the first time you've looked at all the issues with this unit, correct?
Correct, yes.
Okay. And then help me out, just, and believe me, I have no challenge to your credentials, and I never have as an economist, but I just want to ask you briefly. When I look at your LinkedIn page and I look at your website, it talks about the Department of Defense job.
Yes.
Is that a full-time job?
It is, yes.
Okay, so you work there how many hours a week? Or
40.
40 hours a
Yes.
week, okay. And then you're an adjunct professor at LaSalle. Is that a part-time job? It must be a part-time job.
That is part-time, yes. I teach there varies from time to time. Haven't done it in about a year or so, but I do, yes.
Okay, and when you do teach there, I'm guessing that's a night class or
Yes,
a part-time
yes,
class?
night class.
Okay, and then you have your economic consulting business,
Correct.
correct? How much of your time is made up of that? If you're working 40 hours for the Department of Defense and you do the teaching, how much of the time is made up of that?
Well, it's hard to put a number hour on it. I mean, it's a considerable amount of time. I would say I put an equal amount of work into my consulting work as I do my government job as well. I work nights, weekends.
Okay. And then would you agree that as an economist, you're an advocate for municipal unions to help them increase pay and benefits? And you're not an independent expert, you're an advocate?
Well, I wouldn't say that I'm an advocate per se. What I'd like to advocate is presenting the correct information to help units achieve what they want to achieve. But I always give them a very, very unbiased representation, and sometimes the information is not good.
Okay, so the reason why, I don't want to go too far on this, the reason why I want to ask you, on your LinkedIn page, you describe yourself as a collective bargaining economist.
Correct, yes.
I don't know of any such specialty in economics is that something you created? I just don't know.
Well, no, I've heard the term before. I haven't encountered any individuals in my life in terms of meeting them that are collective bargaining economists, but I've heard the term out there.
So you're the one?
I'm the one that I know of, yes.
Okay. And on your LinkedIn page, it says, I am an expert collective bargaining economist that helps police, fire, and other public sector labor unions negotiate better contracts. I've testified at numerous interest arbitration hearings and have assisted many unions throughout the collective bargaining process by providing detailed economic and financial reporting. So you've done one side of this, right?
Correct, yes.
Okay. And then it says you're the president and chief economist of Criminal Economic Consulting. Are there other economists there or just you?
Just me. My wife helps you from time to time by collecting data, but she's more of a statistician.
So
than
you're the
she's an
chief?
economist.
Is your wife the deputy?
Well,
or
she's
what?
the boss outside of the economics world, but when I do economics,
Okay.
I am the chief, yes.
Okay. Now, you also say on your website, we are one of the very few firms that solely focuses on issues related to collective bargaining for police, fire, correctional officers, and other municipal employer unions. Our ability to execute will help your unions negotiate an exceptional contract. We proudly work with labor unions from all areas of the United States. So you still say you're independent, you're not an advocate.
No, I am independent. Usually when I'm called by a union, it's to give them a unbiased representation of the state or county or whatever might be their finances. And no matter what the information that I give them is, it's unbiased and it helps them execute a better contract, even if the contract is not that good. For example, if a certain municipality it has a very, very low income level or their general fund reserves are very, very low. Using that information allows them to get the best contract for that particular unit. So yes, so I give them unbiased information, and however they use that information is up to them.
Do you ever in your professional services say to a union, hey, you guys are pretty well paid, really can't advocate for a higher pay here? For example, I saw you recently in a municipality outside of Philadelphia where the police officers' average earnings are around $140,000. Do you ever get retained and say, hey, you guys are at the top, I really can't help you?
Yes, I've told units that they've been well paid relative to other units.
You also state on your website that municipalities have become more stringent in how they allocate funds and regularly go to great lengths to avoid offering fair contracts. Is that your opinion here, that we're going to great lengths not to offer a fair contract or a fair agreement? No,
that's just a very, very broad term in general. It doesn't apply to any one particular state or governmental unit, so no.
Okay, and then you stated also on your website, lower salaries tend to be associated with higher attrition rates. And economists can offer statistical evidence supporting this claim.
Yes, if the data warrants itself, yes.
Okay, so the data must not warrant it here because I don't see any attrition evidence in your presentation. I saw you cite the RAND study, which has a 20% nationwide attrition rate. Are you aware that the attrition rate for this unit is well below that?
Well, the most recent reading that I saw was 3.5%.
Okay,
so I'm not sure what number you're talking about, but
that would be 17% below the RAND study average.
Well, it wouldn't be 17%. It might be 17 percentage points below.
Okay.
Okay.
Good. Thanks, Doug.
Yeah, sure.
Now, Jeremy, what I usually see when I see you testify is you talk about demographics, household income, right?
Yes.
Okay. Your slides on Pennsylvania demographics, median household income, per capita income, median earnings, male, in what you presented, we're 5 out of 6. We're 1 from the bottom, correct?
Yes, they were relatively low.
Okay.
to the comparable group.
Okay, and usually when I've met you, I see you doing the opposite. In like Chester County outside of Philly, you'll be like, hey, we're low on the demographics, or we're low on the comparables here. Here we're 5 out of 6 in ability. If we look at ability to pay, or we're on the lower end here, correct?
That is correct, and that's why I wanted to also note in that same section about how PA has the ability to generate general fund revenues, which ultimately is more important.
Okay, but you live in Pennsylvania, Jeremy?
I do, yes.
Okay, help me out with this. The ability to generate general fund revenue. That means increased taxes, correct?
Well, if we're talking about an increase in revenue in the future, that may be one of the mechanisms to do that.
Okay. You would agree with me that's very unlikely in the current political climate, where we have a Republican House, Republican Senate, we have anti-tax politicians in control of the government in this state. You don't see tax increases coming down the road, do you?
Well, I can't say that for certain. That would be a speculative guess. All I can say is that it was proposed. It may happen, it may not happen.
I mean, it doesn't take a lot of speculation to read what every politician in the legislature says on the Republican side, like, no way we're raising taxes, right?
It's impossible for me to say whether they will or won't.
Okay. Now, you also have comparables here, and can you go to slide 53?
Yes.
And I'm not trying to be snarky here. You're a smart guy. You're an economist. I'm a lawyer because I'm bad in math, and you're good in math, and you're good in statistics, and you're an economist. Were you bad in geography when you went to school?
Actually, no. I came in second in the geography fair. Or
Okay.
geography being in 7th grade.
All right. That's why I have a question for you. Because I don't want to put up a map, but this says the states listed below border Pennsylvania. What state are we missing?
Well, we're missing West Virginia.
Why are we missing West Virginia? Because it does border Pennsylvania.
It does border, but the second attribute is the contributes to the regional economy.
Okay.
West Virginia being a little bit removed, you really can't compare them to New York, New Jersey as well.
What do you mean a little bit removed? They contribute to the regional economy. Are you insulting all the people of West Virginia that they don't contribute?
No,
to
I'm
the
not.
regional
But the economy is much smaller than the other comparable states. Delaware may be comparable in size in terms of total GDP output, but it's also a bordering state that contributes more to the region than West Virginia does, in my opinion.
You didn't knock West Virginia off because their COs get paid a lot less than our COs.
No, but they also have a very, very low income level too. I would guess that they would be below really all of these.
Okay.
My brother lives in West Virginia, and no insult to anybody in West Virginia, but it's a very rural state, very industrialized. And by industrial, I mean less service-oriented versus Pennsylvania.
Yeah, but Pennsylvania is a really rural state in a lot of areas too, especially where a lot of our prisons are.
In many areas it is, yes.
Okay, so, I mean, and have you been to any of our prisons?
I have not visited a facility, no.
Okay. Like, have you been to FCI Green? You haven't been, right?
No.
Okay, well, FCI Green is closer to Morgantown than it is to Pittsburgh. I mean, it's really close to West Virginia. And if you talk about the economy and the overflow, and some of our members live in the other state.
Well, I mean, there may be a small impact on a particular region, but in the state at large, I think the contribution is rather small.
So can you go back, if you don't mind, Jeremy? Can you go to slide 5, please? So, believe me, and help me with this as a layperson, but during your testimony, you kept talking about when we're recovering from the pandemic economic effects. And I just want to maybe make a basic point or see if you agree with me. So do you agree when we talk about 33.4% growth after 31.4% decline, it doesn't get us back to where we were? And let me give you an example and see if you agree with me. And I have to dumb this down for myself. I apologize. So, for example, you have $100, and that declines 31.4%. So I'm doing math here, which is tough for me. 68. That gets me $68. And then if it grows back by 33.4%, it only gets us back to $91.51. We're not all the way back because we took a big hit and we had the growth on the lower number, correct?
That is correct, yes.
Okay, so you kept saying we're going to recover by this date, but that's not recovering all the losses, right? You're not saying that.
They are recovering the losses in terms of GDP output, and that's projected to occur this quarter by the Federal Reserve Bank of Atlanta. Now, the job market recovery will take a little bit longer, and I noted that in some subsequent slides.
And would you agree with me? I mean, when we talk about '08 and the recession then, Pennsylvania is always a little bit slower in recovering than a lot of other states.
It was slow to recover because Pennsylvania is a less volatile economy. So when that happens, typically when it retracts less under normal circumstances, and when it grows by a slower rate. And that's what we saw over the past decade. The COVID recession is a very, very different animal altogether. We're still studying the effects of that. It was a little more volatile because of the governmental shutdowns that were more severe in PA versus other states.
Okay, so can you go to slide 12, please? Okay. So this slide sort of illustrates the point that we had we have more jobs than at the trial when we went all the way down, but we're still not back, right? I mean, we're still.
No, that's correct. The job market has not fully recovered yet.
Okay. Could you please go to slide 14? So this is the U.S. unemployment rate, right?
Correct.
6.1. Pennsylvania was worse, right? I mean, at the same time, Pennsylvania rate 7.4%, right?
It was, yes.
Okay. And you agree fewer people were participating in the labor market?
Correct, yes.
Okay. Can you next please go to slide 17? So I don't want to go too far on this, but when you say that people are staying home because of the extra $300 in unemployment benefits, is that the economic consensus? Because I see that on a lot of political shows, but I don't know if that's the economic consensus. That's really why we are where we are.
There are other drivers, and I noted that before. It's not the only reason. One of the other reasons that employees haven't returned is hesitancy. Some of that is vaccine hesitancy. Some of it is returning to the actual workspace. Another one is childcare. So it's not the only reason. But it is a driving effect, and most economists do agree that there is some impact of these additional benefits on the labor force.
And no matter what it is, I mean, it affects Pennsylvania because if we talk about our state income tax, we're just not getting income tax on people who are not working. I mean, an obvious point, correct?
I have to double check that number. Even though somebody receives unemployment benefits, no, in Pennsylvania they don't. So now I stand corrected. No, that is correct.
Okay. Jeremy, could you go next to slide 35, please? So this is where you discuss the survey of professional forecasters, correct?
Correct, yes.
Okay. And you testified or you rely upon this for prospective growth rates.
Correct.
Okay. And I just want to talk briefly about one item. You mentioned how some of these forecasts have changed,
yes.
Correct? And would you agree with me a big reason why they've changed from forecasts that were done back in November of last year is the vaccine, right? We've had fabulous progress with the vaccine.
I wouldn't say because of the vaccine. I would say there might be an indirect effect. Because of the vaccine, more people are confident in the economy, and that has spilled over into more economic growth. But I wouldn't say it's solely because of the vaccine.
I wouldn't say solely either, but that's one of the big factors. You would agree, correct?
It would be a factor in the economic recovery, yes.
Right. I mean, when we talk about consumer confidence, if people are now confident, like, for example, they're going to lift all the restrictions in Pennsylvania soon. And I recently went outside to dinner in Philadelphia, and there's a lot of people out now. And you have to get your head around it. You have to go, wow, people are back. But that's coming back, right? Consumer confidence being restored now that people feel safe to go out, that they've been vaccinated. That's
yes.
part of the analysis.
It's part of it, yes.
Okay. So in these slides, you rely upon the survey of professional forecasters for prospective growth rates. They also have in here their forecast for inflation, correct?
Correct, yes.
And inflation, CPI, is forecast to be moderate after a temporary blip. I mean, it's going to hold around 2%, correct?
A little bit above 2%, yes.
Okay. When we say a little bit above, we're like, what are we at, 2.3, 2.3?
2.3, yes.
Okay. Can you go to slide 37 next, please? So similarly on inflation here, the Federal Reserve projects around 2% for future inflation forecasts, correct?
That is correct, yes.
Okay. And could you take us next to slide 46? Okay. I think we sort of went over this already, but this slide shows that we're far from being hitting full recovery, that we hit that trowel, we're coming back, but we still got a ways to go in Pennsylvania regarding job losses, correct?
That's correct, yes.
Could you hit slide 49 next, please? Now, on here, you have the executive budget economic forecast for PA, but you don't have the CPI projections, correct?
Not on this slide, no.
Okay. In the budget, are you aware in the budget that the CPI, the core personal consumption measures of inflation, the forecasts are 1.7% for 2021 and 1.9 for 2022?
I need to revisit the actual slide in the budget report, but that sounds reasonable.
Okay. Slide 53, if you can. Okay. And we sort of hit this already, and you explained why you left West Virginia out of there, correct?
Correct, yes.
Okay. Now, 54, so when we hit 54, median household income, we're next to last, right?
Correct, yes.
Okay. Usually when you testify, when we talk about we're low on the median household income, that means we have less ability to pay than the other states, correct?
Well, it depends on the entire package.
Right,
So,
and we'll talk about that.
Yes, okay, but yes, typically lower incomes hurt the ability to pay.
Okay. And help me here from a layman's perspective, but I live in Pennsylvania. I lived in Pennsylvania my whole life. I hear the term Rust Belt state. I hear about aging demographics. I hear about sort of political fracture where we're not going to see any tax increases. We're going to see sort of stasis and economic budget fights forever. That's what we see here. Pennsylvania is Pennsylvania. When we ranked with other states' economies, we're not at the top, are we?
What do you mean by the top? Can you clarify that in terms of economics or in terms of incomes? Because there's a difference.
Yeah, I mean, I guess when we look at the total package here, and I'll get to that later, but yeah, I'll withdraw that question. I'll ask you a more detailed question on later on. So all right, so let's go to 55. So per capita income, again, we're next to last on that too when we look at your comparables.
Yes.
Okay, let's go to 56. Median earnings, male, full-time, again, we're next to last here.
Yes.
Okay. Now, I want to keep that in mind when we get to your slides, your pay slides, 105 and those other slides, what we went through here, if you don't mind. I want to keep you in mind that we were fifth out of sixth on demographics, and you would think they would transfer to fifth out of sixth out of pay when you're comparables.
Oh, not necessarily.
Okay. Slide 57. Now, this one, I'm not going to accuse you of being tricky, but this one I found, it confused me at first when I read it. So it says PA is generating a substantial amount of tax revenue. Relative to the other comps, 2 out of 6. These figures don't account for a population, do they? Because, for example, Delaware is a very, very tiny state, and we're just doing revenue by, we're not accounting for population here, are we?
Well, yeah, you would be correct.
And Ohio, New Jersey, Maryland, Delaware all have lower populations than PA.
Correct, yes.
And in fact, if you look at this slide quickly, it's a little bit misleading, correct?
I
know you didn't intend it that way. But
no, I wouldn't call it misleading. I would just,
okay.
It's a statement of the facts.
Okay. I mean, I'll give you an example. The city of Reading produces more revenue than East Whiteland Township. It's one of the wealthiest townships in Pennsylvania. But if we look at the population and we look at the expenses and we look at the real books, the city of Reading's in Act 47 and in severe financial stress. We have to look at all the factors, correct? Not just the revenue.
That's correct. Yeah, that's just one factor.
Okay. Slide 61. Now, you state here, it says Pennsylvania has very favorable bond ratings.
Yes.
You're standing by that?
Yes.
Okay. You're aware, though, compared to other state governments regarding bond ratings, PA ranks really, really low.
I didn't take a look at all the states, so I can't comment on that. But in terms of investment grade debt, it's a good rating.
Okay, so I'm going to help you with this and see if you have a chance to look at this. Are you aware the S&P rating for PA is A+ with a negative outlook?
Yes.
Okay. Now, A+ sounds good in high school, right?
Yes.
Yeah, and we're not in high school, though, when you talk about bond ratings. Bond ratings are, and you're the expert on this, Jeremy, not me, but bond ratings are a little bit different when you have an A+ with a negative rating. So help me with this. Bond ratings. You get a high quality, high grade rating, that's AA. You get an upper medium quality rating, grade A. You get, there's different ratings for bonds, correct?
Yes.
Are you aware most states are AA and many are AAA in their ratings?
I believe that to be correct.
Okay. Are you aware the S&P ratings, with the S&P ratings for bond ratings for states, PA is tied for 47th out of 50 in bond ratings?
That might be. Yeah, I don't know for sure what the actual rank is, but that sounds
Okay.
about right.
And when I say 47 out of 50, I mean 40. I mean the worst.
Yes.
So we're tied with Connecticut, which is an A+ rating, which is stable, while we're negative. Are you aware of that?
Yes.
Okay. Are you aware that PA is ranked 47 out of 50 by S&P bond ratings, and we're only ahead of Kentucky, which is A, New Jersey, which is BBB+, and Illinois, which is BBB minor?
Yes, I'm aware of that. But you have to keep in mind, too, when we talk about bond ratings, it's not so much which state is better. It's how well can the state meet its obligations. And when a state has a rating of an A or higher, that's a good rating. It's investment grade. There are also other investment grades that are lower as well.
Can you take me to slide 66 next, please? And I'm going to ask you a couple more questions about bond ratings and S&P later on as we go through some of your slides. But I just want to, I'm trying to keep this slides in order so we keep maybe not a less confusing flow. Modified net position. Help me with this as a non-economist. Isn't this like I ignore my mortgage, I ignore my car loan and my student loans, and I say I don't have a lot of debt? I mean, what's modified net? How does this work?
So modified debt, there was a change in the way that the net position was calculated. Right, the methodology for calculating it is determined by the Governmental Accounting Standards Board. And they mandated multiple times in the past to include certain levels of debt that weren't included before. Now, when we look at the slide 64, this is the entire net position. This is with those pieces of information, debt pension liabilities and OPEB. Prior to that, they weren't included, so that's why I didn't include previous years. They also weren't reported anywhere in the CAFR report, at least that I could find, or at least an accurate number. And I'm not an accountant, so I couldn't try and devise that number myself. So that's why those years weren't included.
Okay, can you go next to slide 72? Okay. You compare in this slide general fund revenues and expenditures, correct?
Yes.
And I know this is the first time you're doing state corrections, so I want to ask you, you do something a little different here, and I want to ask you why or whether you realize you're doing it. But you do something different here than the Governor's Budget Office, than the IFO does, than S&P does, than Moody's does. You combine general fund revenues with federal funds. Mostly Medicaid funds, which make up 47% of the total in 2019 and 20. Are you aware you're doing that?
Oh, yes, I'm aware.
Okay. So in the Commonwealth, the 1920 Annual Finance Report, the federal funding is listed as intergovernmental revenue. General fund spending and revenue is generally limited to state-generated revenue, not federal funds, because the Commonwealth never really knows. That's not a certainty what federal funding they're going to get, but you include.
That's correct, yes.
Okay, so you include that. So your different analysis throws these numbers off. I mean,
well, I wouldn't say it throws them off. I mean, I try to highlight the best I could for the different sources. The different sources tell you to include certain funds versus not including those funds. According to the CAFRs, these are the GAAP procedures. They say to use those funds from the federal government and expenditures in the general fund. Okay, when we talk about the PA budget, that's a different accounting standard. There aren't as many restrictions, and I try to highlight that as well, that those funds aren't included when we talk about general revenue funds from the PA budget. So I try to differentiate the best I can.
Okay, so can you take me next to slide 74? So you talk about the Gfoa here, correct?
Yes.
And just for those that don't know, what is the GFOA?
Government Finance Officers Association.
Okay. You state that the GFOA recommends that a government hold 17% of expenditures or revenues as unrestricted reserves, correct?
Correct, yes.
But you make a difference here. You go on to say large governments, such as states or counties, may hold significantly lower levels of unrestricted reserves, correct?
That's correct, yes.
Okay. But one thing you leave out here, and I don't know if you consciously left this out, I just want to ask you about it. You leave out something here, because I went up on the GFO website, and the GFO recommends, at a minimum, general-purpose governments, including states, regardless of size, maintain unrestricted fund balances in their general fund of no less than 2 months of regular general fund operating revenues or regular general fund operating expenses. Are you aware of that?
Yes, that's the same principle as the 17%. It's actually 16.67, 2 months of operating revenues or expenditures. But in that footnote, that's where it makes the note that they can hold significantly less as well.
Okay.
Okay.
So they're under their recommendation for what states should be doing. I just want to run this by you. Under their recommendation, by this standard, PA should have, according to the GFOA, about $6 billion in our rainy day fund.
Well, I wouldn't say it's a recommendation for the state. It's a recommendation across municipalities in general.
Okay.
But it does state that there are exceptions to that rule.
Okay, but we're a municipality in general, are we not? I mean, we're a
We
state.
are, yes. But it
Okay.
also says it can hold significantly less. So that's why I can't really marry their health to that 17% number.
Okay,
They
but
are in different categories.
I just want to drill down to this, well,
Yeah.
not lengthy, but I just want to make you aware of this or ask you about this. So under their recommendation, and I know you can go less, but we're going way less. I just want to run this by you. So under their recommendation, we should have $6 billion would it be in our rainy day fund. So we would take our budget, or a $36 billion general fund budget, divide that by 12 times 2 months, $6 billion. Are you aware, as of yesterday, when I spoke with the budget office, the Budget Stabilization Reserve Fund has $244 million?
Well, the budget-
Let me just finish, Jeremy, if you don't mind. We have 4% of what the GFOA recommends. I know we can go lower, but we're going 96% lower. So that's where it seems a little concerning.
Yes, it is below the 17% that's recommended across the board. But certain circumstances will allow municipalities to hold less if they can.
I mean, but we're catastrophically lower. We're not going a little bit lower.
It's not for me to say what the right level is.
Okay, but we're pretty low, are we not?
We are below 17%, yes.
Okay. So let me get back to the bond ratings, and on your website, you talk about how when you represent a union in a proceeding, it's good to have a consensus or have consensus reports, correct?
Correct, yes.
Okay. So I want to ask you about the S&P reports, the rating agencies. They're independent agencies, correct? They're not run
Correct,
by the
yes.
Commonwealth. S&Ps, Moody's, Fitch. Now, they all cite PA having a very small fund balance as problematic.
They do,
as really
yes.
problematic.
They do, yes.
Okay. And are you aware, according to the National Association of State Budget Officers, their fall 2020 fiscal survey of states, that there's only 4 states out of 50 that have a fund balance less than 1% of expenditures, and PA is one of those?
Yes, they are.
Okay, so that's not good, is it, Jeremy?
No, not on the surface, it's not good.
Okay, so we're one of the worst states in the country for that.
In terms of reserve levels, it's low, yes.
Okay. Are you aware that the median state rainy day fund nationally is at 8% and PA's is less than 1%?
Yes, but
Again,
PA also has a very stable revenue source, more stable than most states, so it allows them to hold less reserves if their economy allows them to do so, and that may be the case in Pennsylvania. So again, yes, it's below the 17%, but Pennsylvania has a different ability to hold less reserves because they have such a stable revenue stream.
Okay. Can you turn next, please, Jeremy, to slide 80? Okay, on this slide, you say, despite the challenges presented by COVID-19 pandemic, every agency maintained their favorable rating. And you're talking about Moody's, S&P, and Fitch, correct?
Correct, yes.
Okay. And then can you go to slide 82, please? Okay, on 82, you list highlights from S&P, Moody's, and Fitch. Fitch's ratings, correct?
Correct, yes.
And would you agree that they're consistent, Moody's, S&P, and Fitch, they're pretty consistent in their
For the most part, they have different models by which they assign their ratings, but for the most part, they look at a similar piece of information.
Okay, and then on 80, again, you talk about a favorable bond rating despite the S&P having a negative outlook on the Commonwealth and a low rating compared to almost all states, correct?
It's still a favorable rating in the world of corporate bonds, municipal bonds, yes.
Okay, and then 80T, on page 82, we have the highlights from, and you cite the Moody's April 2021 report, correct? Rating
Correct,
report?
yes.
Okay, so I don't want to go, again, I don't want to read all of this because we'll be here till doomsday, but I have the Moody's report, and you cite the highlights. There's a lot of lowlights in here, is there not, Jeremy?
Yeah, anytime there's not going to be a perfect score, there might be some lowlights as well, yes.
I just want to read a couple of them to you and see if you agree, and I'm reading from the actual report. Although Pennsylvania's near-term credit profile has stabilized in recent months, giving increased economic activity across the country, we believe longer-term pressures remain. In our view, Pennsylvania's fiscal challenges are recurring and deepened by a failure to fully recover from the effects of the Great Recession. Following a decade of chronic structural imbalance in recent years, the Commonwealth had narrowed but not eliminated its structural budget gaps, given strong growth during the economic expansion and slower increases in required pension contributions. Its liquidity management regularly relied upon internet borrowing during the expansion, and the Commonwealth's reserve profile did not significantly improve during the expansion. The largest deposit to the rainy day fund in over a decade, made in early fiscal 2020, brought reserves to just 1% of annual general expenditures, which is less than half of the Commonwealth's reserve position entering the Great Recession. We believe Pennsylvania's budgetary management is challenged by not only the state's minimal reserves, but also a chronic reliance on one-time measures, high fixed costs, increased liquidity demands, and history of budget stalemates. It's pretty negative, is it not, Jeremy?
That particular blurb is, yes.
But again, I don't want to keep this here all day, but there's a lot of this in here. So it goes on to say the A+ rating reflects, it goes on to state some positives that you listed there, but then it says offsetting these credit factors are what we consider the Commonwealth's diminished financial flexibility and rising expenditure pressures due to increasing Medicaid costs, large unfunded pension liabilities, limited revenue growth, minimal financial reserves of $343 million or 1% of general fund expenditures in fiscal 2020 that are projected to decline to $242 million following $100 million withdrawal in the enacted fiscal budget, projected revenue and expenditure misalignment, which we believe remains a challenge to Pennsylvania's credit profile despite some improvement in structural imbalance in the past few years. The budget gap before the pandemic in fiscal 2019 was estimated to be 2.9% compared with a 5.0% gap in fiscal 2017 and weak three-year average funded ratio of 56.6% across the Commonwealth pension plans, incorporating a fiscal 2020 funded ratio of 54.3% for Pennsylvania School Employees Retirement Pension, PSERS weak, and a funded ratio of 63.1% for Pennsylvania State Employees Retirement System, SEERS, weak as of December 31, 2019. The negative outlook reflects our view that there is at least 1 in 3 chance we could lower our rating on the Commonwealth. In our opinion, a recent uptick in economic activity has contributed to some improvements in Pennsylvania's near-term credit stability, but uncertainty remains regarding longer-term budgetary pressures. The Commonwealth must now shift its focus on addressing near-term liquidity and budget demands to finding ways to structurally balance its upcoming budgets in an environment where unprecedented levels of federal stimulus and direct aid have provided a boost for state governments. We believe this could challenge Pennsylvania given its high fixed cost profile and history of contentious budget negotiations. In addition, the Commonwealth's reserve balance is minimal, leaving Pennsylvania with little budgetary cushion. Now, that's all very bad and very sort of scary to be reading that in
Yes,
in a
those
rating.
particular sections are, negative attributes to the state's financial position. But ultimately, if those negative attributes overcame the strong points that I had listed on this page, the ratings would have gone down. And ultimately, they have not gone down. So that does not impose as much of a problem as what that particular paragraph states.
Okay,
in terms of the bond rating.
So I would ask you this, does this change your mind if I read you an additional paragraph? They go on to say, the negative outlook reflects our view that there is at least 1 in 3 chance we could lower our rating on the Commonwealth. In our opinion, a recent uptick in economic activity has contributed to some improvement in Pennsylvania's near-term credit stability, but uncertainty remains regarding long-term budgetary pressures. That cause you to pause and hesitate? In what
No,
how you
it
understand
doesn't, because ultimately it didn't change the bond ratings. So it doesn't change my opinion based upon the bond ratings either.
Okay. So, Jeremy, when you presented this and you present the highlights, why did you leave out all the lowlights? Because, again, I don't want to keep us here, but we will introduce this report and the ratings reports in our rebuttal case or our case, but there's a lot of negatives here that are not even mentioned in
There are, and that's why the state doesn't have a AAA score. There are some negative points, but I wanted to highlight the most important points as to what gave them the ability to pay in this analysis. And
Okay.
those are the strong points.
Can you go next to slide 94, please? Okay, so you assume revenue growth, you assume that Governor Wolf's proposed personal income tax increase of 3.07% to 4.49% will go through, correct?
Well, I didn't make that assumption, and I pointed that out when I gave the presentation, that this was just a proposal. This may or may not go through. I can't determine if it will or not. So these numbers are just based upon those projections with the proposals going through. So the projections given by the state do assume that those proposals will go through.
Do you agree with Moody's and S&P that raised some doubts that they think it's going to go through with the current legislature?
I can't comment on that because that would be a personal opinion, not an economic opinion.
Slide 96, Nez. So in here, you have the governor's proposed corporate tax changes, correct?
Correct, yes.
Now, they've been proposed before and the legislature hasn't passed them. You're not going to, are you assuming they're going to pass, or you're not assuming? Where are you in this?
No, what I'm assuming is that this will pass if it presents an economic advantage to the state. So however that winds up being.
So are you saying it'll pass if it's a tax increase for corporations? The Republican legislature will pass a tax increase for corporations in Pennsylvania? Is that what you're saying?
No, it's a different tax structure is what's being proposed, not just a tax
but you're
increase.
saying it'll pass if it brings in more revenue.
Well, I don't know if it'll pass or not. I'm just saying from an economist standpoint, it's unlikely that the state would make a projection or make a projection from a tax structural change where those projections decline over time.
But you're confusing me, and I know you're not trying to do that, but help me out. You're saying you don't think they would pass a corporate tax change that will not bring in more revenue, that will bring in less, correct? Is that what you're saying?
Yes, I'm saying that it seems unlikely to me as an economist
Right.
that it would be passed if the ultimate goal was to bring in less revenue.
But if they pass a corporate tax change that brings in more revenue, that will be a tax increase for corporations, correct? That's how you bring in more
Not
revenue.
necessarily, no, because they actually proposed a tax reduction and a change to the tax base. So it's not a tax increase that they're proposing in this situation. It's to change the entire tax structure.
Okay, and if you change the entire tax structure, if you increase taxes, it goes up. If you lower them, they go down, right? Or you're not doing a trickle-down discussion here,
Well,
are
no,
you?
it's actually proposed that taxes will decrease for corporations.
Okay. I don't see anywhere in your presentation where you talk about the PA's mature aging population, the increase on the pressures that the state faces on revenues since when people retire, their income's not subject to personal income tax for the state, and the increased expenditures on Medicaid. Because I read a lot about that in the ratings reports. I don't see it anywhere in your presentation.
No, it's not in here.
Is there a reason why it's not in there?
No, no particular reason.
I mean, it's big. Is there a reason why you're not looking at that?
No, I thought it was more important to focus on the baseline finances and their economic characteristics rather than those particular.
But we're talking about ability to pay, and the state's facing a looming crisis with more and more people in the state getting older. the birth rate not replacing, and Medicare costs increasing, that doesn't go into your ability to pay analysis?
No, because I'm looking mostly at incomes, and those situations that you discuss are already included in the income levels that I presented originally. So when someone retires, household income goes down, that information is already included in those slides. It's already built in.
Slide 102, Jeremy, if you could. Okay. You're an economist, sir, but you're not a legal expert on the American Rescue Plan and what legally the Treasury allows municipalities, including states, to do with these funds, are you?
Yeah, that's correct. I'm not a legal expert.
And there's teams of lawyers all over the country working on, and there's lobbyists from states, cities, boroughs, townships trying to expand the narrow regulations on how municipalities and states are allowed to spend this money right now. Are you aware of that?
Yes.
Okay. You're aware that the ARP monies, the American Rescue Plan monies, can't be used for the state's rainy day fund, correct?
That is correct, yes.
Okay. And you're aware there's many, many restrictions. It can't be used for debt, legal judgments, rebuilding reserves, correct?
Well, there are other funds, too, in the American Rescue Plan Act, and some of those restrictions that you mentioned may be attributed to other funds outside of the Coronavirus Relief Fund. So I can't comment on all of those, but I do know that the two restrictions on the American Rescue Plan funds that are a part of the Coronavirus Relief Fund, the local fiscal relief fund, the only two restrictions that I'm aware of on those are they can't be contributed to pensions and they can't be used to lower taxes. There might be other restrictions on other funds as part of that act, and I can't comment on those.
Are you also aware that money goes to the legislature and the legislature decides what's going to happen with it?
Yes.
Okay, and you aware there's also a portion of that involves giving monies to businesses that may have lost incredibly revenues during the pandemic?
As part of the American Rescue Plan Act, there are funds dedicated to that, but there's a lot of leeway in this $7.3 billion. So some of those funds could be used to businesses. It's up to the state how they use those funds.
Right. So you don't really know how much money the Commonwealth's really going to have to even use under the restrictive
Oh, well, they're going to
rules.
have $7.3 billion. That's been decided by the Treasury.
Take me next, if you can, to slide 105. Now, I don't want to harp on this, but we don't have West Virginia in here. But even without West Virginia, PA ranks above the median in most years in your exhibit here, correct?
That is correct, yes.
Okay. And you agree this is true despite your previous slides that show significantly lower income and earning levels in Pennsylvania relative to the other states?
That's correct.
Now, you don't include benefits at all here in this analysis. Is there any reason why not?
Because benefits vary widely across states. Some states have collective bargaining rights that are quite strong. Some are not. I don't know the actual differences between every single one of these. Again, I'm not a legal expert. But base pay and longevity were common across all the states, and that's the easiest one to compare.
Okay, take me to, if you could next, please, to slide 107. Now, you talk about PA lags in early years of the pay progression, correct?
Correct, yes.
But this isn't true for relative to Delaware and Ohio, correct?
That is correct.
Plus, you associate early career pay with recruitment challenges, correct?
There may be challenges. I can't say for certain.
So let me help you with that. You don't cite any evidence of any recruitment difficulties in Pennsylvania. Are you aware there's over 8,000 people on the current eligible hiring list for this unit?
I had to refer to the PSCOA for that information. I don't know.
Well, I just asked the Commonwealth, and they told me. Are you doubting that number? Or?
No, I
Okay.
just can't confirm it. That's
So
all.
if it is 8,000, does that cause you to revise this slide?
Not necessarily, because it also depends on the quality of recruit as well. And again, I'm not a PSOA member, so I can't comment on the quality of recruits. But they could be looking for recruits that have a greater skill set than what's currently in the pool. I can't say for certain, but that does present a recruiting challenge.
But you can't have it both ways, Jeremy. You can't say that one of the factors is whether we have people on the list, and then we tell you we have 8,000 people on the list, and you say, well, they may be all.
But it's still a recruiting challenge if you don't have the recruits that have the skills that you need. And it could be a challenge. And I'm not saying that it is or isn't, but I'm just saying that it could be a challenge.
But the agency that sets the recruiting requirements and the requirements for the job is the Commonwealth, correct?
Correct.
Are you saying there's a problem with that? Or
No, I'm not saying there's any problem with that.
Okay. 111, 112. If you could, let's start with 111. These slides, 111 and 112, they show that PSCOA wages have outpaced inflation, correct?
No, these are the effective base wages, but this slide, yes, 112.
Yeah, 112,
Yeah.
I'm sorry, yeah. Okay. If you can take me next to 115. Now, in your presentation, you argue that CO wages have lagged annual wages in PA, correct?
Correct, yes.
Okay. But help me out with this. Annual wage figures don't take into account shifts in occupation, do they?
No.
Okay. Plus, average annual wages shown for general labor market only count people with earnings, correct?
That would be correct, yes.
They don't account for jobs lost or rises in unemployment, do they?
No, it includes people who are working, yes.
And then when you compare this, the general labor market doesn't have the pensions that this unit has or the level of active employee health care.
Well, some do, yes. So there are pensions included in that. So included in this average annual wages are those who don't have pensions and also those who do have pensions. So there are some employees that do have pensions in there.
You also use the use the wage tracker, correct?
Correct, yes.
And you can go to that slide if you want to. The wage tracker looks at actual earnings for individuals from year to year, correct?
Yes.
Now, when you do this, you're not including, when we talk about COs and you're comparing in the wage tracker, it's not including steps in longevity, is it?
That's not, no.
So this unit, the steps in longevity right now, I think this year they're worth like 3.08%.
Yes. So let me clarify that point you're making because it's a very, very good point. Steps in longevity, they are intended to compensate officers from year to year for an increase in their experience. So when a correctional officer has 6 years experience versus 7 years experience, that higher step that he or she receives represents the additional economic benefit that they provide as being a CO.
I understand that, but
So
it's sort of
when we
apples
look
to
at
oranges.
so when we look at these wages on this line here, this looks at the same grade from year to year. So that same grade from year to year is reflective of the labor pool because that reflects the same amount of experience from year to year. After you filter out retirements and new hires, that average employee, whether it be wage tracker or whether it be average hourly earnings, remains the same. So for each year that we look at this, whether it be average of 10 years, 15 years, that average stays the same. The PSCOA, if they have a step increase, that represents a different work altogether. So you really need to filter that out and look only at base wages for a particular experience level over time and how that compares with the labor market.
But if you filter it out, it's sort of an apples to oranges comparison.
No, it's not. It's actually apples and apples when you keep it that way because when we look at wage tracker, when we look at average hourly earnings, we also have people retiring. So that age of service, the years of service stays the same. It's not a new position. So for example, when we look at wage tracker from 1 year to the next, we don't have 10 years of service in 1 year versus 11% or 11 years in the next year. It stays 10 years every single year. So it's the same level of expertise in the labor market. So we have to look at this same level of expertise in the PSCOA when we make those comparisons.
So we're just going to disagree, Doc. I say apples and oranges. You say apple to apple. Oh, I'm sorry. Let me turn this phone off. Sorry about that. Doc, or Jeremy, can you go to slide 119, please? So the RAND study, I took a look at this. This is a nationwide study, correct?
Correct, yes.
And it gives, again, it gives corrections turnover of 20% when the PSCOA numbers are way, way, way lower, correct?
Yes, and that might be an old number too, so I can't comment on the number. I actually forget what it is, but it is higher than what the PSCOA had in previous years.
Okay. I want to ask you a couple questions because we've done some work in the state of Maryland, and I want to ask you some questions about your Maryland comps. Whatever slide you want to look at or whatever you want to look at, I just want to make sure we're on the same page when we talk about the Maryland comps here. Just a couple questions. The Maryland annual step increases, step increments you show as 3%. Is that correct?
Approximately. I don't know what it is year over year. I need to calculate that, but I'll take your word for it. That might be right.
So from our review, they appear to be in reality about 1.9%. Does that cause you to, sure you're looking at 3%?
Well, I need to look at the numbers. I mean, I can't
Okay.
do those calculations in my head.
Are you of the understanding that Maryland's COs are on a pay range or a pay scale or how they're paid?
They have a pay scale.
Pay scale?
Yeah.
Are you aware that Maryland has a retention supplement?
No, I'm not aware of that.
Okay. Are you aware there's a 4-year, $21,500 retention supplement?
No, I'm not aware.
Would you redo some of these slides to focus in on that?
I need to see the contract, but if I need to redo that particular column, I'm happy to do so.
So that was not obviously included in your analysis?
No, it was not.
What was the job match you did when you used Maryland to PA?
I need to look at the scale. There were a bunch of numbers. I think it was CO1 they said was the equivalent. I think that was our officers. I think CO2 was the corporals. But I mean, I could be mistaken, so I need to revisit which actual series I used.
Do you know whether corrections officers in Maryland receive longevity or base pay only?
I'm not sure I follow the question.
Do they get longevity?
I have to check the numbers again.
Okay.
Yeah.
In your analysis, did you look at the IFO reports, Independent Finance Office?
Yes.
Okay. And you're aware they're putting out, I think they're putting something out this afternoon.
They are, yes.
Okay. I think that is it. Thank you, Jeremy.
Thank you.
Any questions from the panel?
We're good. Thank you very much, Dr. Krimmel.
Thank you, Jeremy. With that, we will, I think it's time to break for lunch.
Okay, same as the prior 2 days, come back in at 1:15. Does that sound right to you, Chris?
Yes, sir.
Okay, so break for lunch, come back at 1:15. Well, welcome back, and I thank you all for your promptness. You've been very good at that. And I think we're ready to begin the afternoon session. Chris, I'll turn it back over to you.
Thank you, Mr. Arbitrator.
Actually, we were going to make an objection before the beginning of the PSCOA's presentation at this juncture. I have a document that pretty much outlines the information necessary to cover the objection. I'll pass that out first, and then I'll provide an explanation as to what our objection is. Multi-page document in front of you. On the first page is an exclusive list of 6 of the PSCOA's issues in dispute, which they submitted to the neutral arbitrator on the agreed-upon deadline of May 3rd of this year. The nature of our objection to these specific proposals is this, and that is that these proposals were not submitted during the bargaining process. They were never brought to the table. They were never discussed. They were never alluded to. They're not amendments of existing proposals, and quite frankly, the first time we saw them was when we swapped documents on May 3rd. If interest arbitration is a natural outgrowth of the bargaining process, then not bringing these to the table and making them a part of the bargaining discussions that led up to that deadline really flies in the face of that principle. It deprived the Commonwealth of the opportunity to try to address these in bargaining. It deprived us of the opportunity to react to them strategically. And even though the objection is to all the issues listed on that first page, it's especially egregious on the classification items that we're going to hear a presentation on shortly, as classification issues, especially how a classification is allocated and assigned to the pay schedule, usually requires a very in-depth classification analysis that takes a fairly long period of time, during which classification principles can be brought to bear. And with all due respect to the expertise and on the panel, bringing them forward the way they have been brought puts the panel at a disadvantage, where these were not issues in dispute that grew out of bargaining, and that they're therefore improperly before the panel.
Thank you, Mr. Arbitrator. I guess I'll start by noting that interest arbitration is not the natural outgrowth of bargaining. Interest arbitration is where bargaining quite unnaturally ended. And it's time for you to make a decision, members of the panel, instead of us making a decision mutually. And we are in an Act 195 forum as opposed to an Act 111 forum. But I'll bring up Act 111 in pointing out that Act 111 requires that issues in dispute be identified and provided within a certain time. And the courts have regularly held that where you didn't provide an issue in dispute and narrowed your issue, that it was beyond the scope of the arbitrator. Act 195 does not have those same requirements. And what's interesting is there's no requirement of identifying issues at all. Frankly, the only suggestion there comes from the Bureau of Mediation when they say, please provide your issues in dispute to the arbitrator. The Bureau of Mediation doesn't say, please provide your issues in dispute to the other side. It's strictly to the arbitrator. And so what we did mutually between the parties was agreed to provide our issues in dispute 20 days before we started, which gave the Commonwealth ample opportunity to review and prepare to respond to our issues, and vice versa. What's interesting, and I'll note from our last proceeding where we had these same parties, Mr. Lowe, Mr. Harvey, and myself, where the Commonwealth actually amended their proposals the morning of their presentation. And I placed an objection on the record. Not that we shouldn't be hearing the proposal, but that the amendment was horribly untimely because it was that morning. And I specifically said on the record, we've now had 6 minutes to review this proposal. Mr. Harvey pointed out, well, if you want time, you could certainly have more time. And Mr. Lowe said appropriately, I agree. If you have not had enough time to review these, you could take the time you need. We'll give you that time. But the point is the proposals continued to move forward. And that's how it works under Act 195. And if you have something in Act 195 to support your objection, I'd be happy to accept it and maybe brief it. Now, on the issue of classification proposals, I understand that there is a lengthy process. The Commonwealth has agreed to, which is to eliminate step 1 in that classification grievance process, because part of that lengthy process is absurd. And it's not even necessary, because there's a lot of people who want to stick their finger in the soup that don't need their finger in the soup because somebody else is going to make a decision anyway. And to now say that we put you as a panel at a disadvantage, I think undermines your authority and challenges your intelligence. One, because we know you, Mr. Arbitrator, have extensive experience as a classification arbitrator. Number two, the very person that the Commonwealth previously relied upon in their classification grievances is going to testify today on behalf of the PSCOA. There isn't many people else in this Commonwealth who are in a better position to talk about that grievance or decide that grievance than Mr. Winters and Mr. Lowe. So with that, I respect your objection. However, I believe it should be respectfully overruled.
Yeah, I would just disagree with his characterization of interest arbitration as not growing out of bargaining. I again reiterate, this is not an amendment to existing proposals. This is adding 6 completely new proposals, and I in no way meant to disparage the panel. And in fact, you and I have had a number of cases together, Bill. You know I hold you in the highest of esteem. So that's all I have.
Very well.
Okay, the panel agrees we'll take this under advisement, but we're going to move forward with the presentations.
Thank you.
Thank you.
At this time, we're going to present the testimony of Hank McNair on a handful of proposals to kind of bridge the gap between Jeremy's presentation and Ralph's presentation. Before we get into the first slide, Hank, we had Jeremy cost out the proposal regarding there is a substantive reason, though, why the PSCOA wants to do that. Why is that?
Yes. Good afternoon, everybody, first. There's the driving factor of the pension plan and how it's changed. We now have to retire at the age of 55 for any new incoming employees, which added 5 years. It used to be 50. So naturally, the 5 years in the longevity from 28 to 33. If a person was to take this job now at 21 years old, they would have to be 34 years in before they would retire at age 55.
Thank you. Prior to our start just now, I've provided you guys with the slides that we'll go through. Hank, our first proposal here that we're going to discuss is regarding Article 10, Section 14, Schedule 2. And the proposal is to increase the sick leave buyout at the rank of 0 to 200 days from 40 to 50%, and at the 201 to 300 days from 50 to 60%. Why is it that the PSCOA wants to change this and increase that buyout?
Well, we believe that this proposal would be an incentive for members to approaching their retirement, that they would try to use less sick time. Potentially at a higher buyout, the Commonwealth would benefit by having individuals leave when eligible.
How does your sick leave actually accumulate?
Sick leave is paid on a percentage every pay period.
And is that same sick leave increased when you don't use your combined leave?
No, it increases over the years depending on your amount of service in.
Okay. So you build a bank of sick leave, and you have certain strictures in the contract that dictate how you can use your sick leave, correct?
That's correct.
So I couldn't call off sick tomorrow and use a sick day.
The way it stands currently, no.
Okay. So it's not always easy to use your sick leave. So you do have a tendency to increase your sick leave balance over the course of your career, unless you have lengthy illnesses.
Yes.
Okay. Any questions on that proposal? No. The next is relating to classification. Article 25, Section 2, Step 1. Now, this is the process whereby we're actually grieving or challenging classifications, and your proposal is to eliminate that Section 2, Step 1. And for the benefit of everybody here, the actual contract language here is here on the screen. Why are we looking at eliminating Step 1? And also, if you're What is your understanding of the Commonwealth's position on this elimination?
First, I think we both agreed originally to eliminate this section in part. When we have a grievance that deals with classification, it first starts off at the department. So let's say, I'll give you an example with the Department of Corrections. They review it first. It's a frivolous procedure because every single time it's denied and every single time it's moved to the next step for the Office of Administration. The Office of Administration is the one that actually handles it.
And that's step 2?
And that would be step 2, yes.
Okay.
So that's why just eliminating that process, there's no need for the DOC to get involved, just let it go directly to the Office of Administration and let them take care of that at step 2.
Any questions or concessions on that particular proposal? Okay, thank you. Next is Article 25, Section 2, Step 3, which is regarding the weight of the decision of your panel of arbitrators once it gets that far. And your proposal is to provide that the decision of the panel shall be final and binding and remove references to the panel's decision being advisory. What is your intent here?
Well, yeah, you pointed out step 3, paragraph 3, the last sentence there. In all other cases, the decision of the panel should be advisory only as to the employer. If we're going to an arbitrator, we want that decision to be final and binding. We don't want it to be advisory. The whole idea of going to an arbitrator is to make a decision that is final and binding for both parties.
And if I understand this correctly, in cases where you're downgrading somebody, essentially taking pay away from them, the decision is final and binding.
That's what the contract says as of now. Yes, so basically in my eyes, if the Office of Administration won and somebody got downgraded, then that's final and binding. But if the union side, if their case won and the arbitrator decided, that's only as advisory.
Okay. Now, the Commonwealth has suggested, well, we routinely abide by the arbitrator's ruling, even when it's advisory. Do we really need to change this contract language in light of that?
Yes, I believe so, because there's plenty of cases where it's not only, I can't say that they didn't follow it, but it leaves it open to how many times have we had appeals, either on the Commonwealth side or on the union side, through arbitration.
Understood. Any questions as to that article? Next is Article 27, Section 5B. This proposal goes to filling classified positions without the need for a score. And essentially, what you want to do is identify one portion of the contract that should be followed for without a score, and our next proposal is with a score. Why? Because I've read the contract and it seems pretty clear. Why do we need to say you must use this section for this and that section for that?
So we've had many grievances, many cases, many events where really both come into play, 5B and 5C, with a score and without a score. And the problem is, mostly with the Department of Corrections, they'll post a promotion, and when they post that promotion, they'll put it up by score. There could be 2 scores, there could be 5 scores. If they don't like the candidate of people that are actually interviewing that have scores, after the interviews are originally done, they will pull down that posting, say nobody's qualified, and repost it as without examination. So it leads them to do whatever they want with going back and forth the way it is now.
So essentially, you have a position that's already been posted with testing and scores.
Correct.
And then they change it to be posted without a score.
Yes, and to be honest, we fought this through the grievance procedure. There's been an arbitration that's gone against us, and we've had settlements before going to arbitration that's been with us. So this is a continuing battle that we have with the Commonwealth, and we would just like it to be, say, exactly that. If it goes up posted by that way, that's the way it should be interviewed for and given.
Okay. So I will skip the next slide because I think it's pretty clear in terms of which should be which. Any questions as regarding this proposal? The intelligent folks in the room would ask you to put your mic on when you speak.
Obviously, I'm not intelligent. Thank you. So stipulated. Thank you.
That's jab one, Mr. Harvey.
That was the one good one you had. That was good.
Thank you, thank you. Next, we will call Mr. Winters and his witnesses to present their cases. I will note for the panel's interest that at tab 3 is Mr. Winters' report regarding the wastewater treatment plant foreman and the water treatment plant foreman. And at tab 4 is his report regarding the corrections commissary clerk. It is not. Good afternoon, Mr. Winters.
Good afternoon.
Could you state and spell your name for our record here today?
Ralph Winters, R-A-L-P-H, W-I-N-T-E-R-S.
And could you briefly describe your work experience in the world of classification for the Commonwealth?
Sure. I have over 35 years of experience in human resources with the Commonwealth. The first 5 years were in line agencies where I performed various types of HR duties. Subsequently went to the Office of Administration, where I served as a classification grievance analyst, investigating, responding to classification grievances at the last step of the grievance procedure, and testified at those hearings about the Commonwealth's decision. Subsequent to that, I was promoted to the grievance unit supervisor, where I basically directed the investigation and responses to grievances, participated in those grievance investigations, and advocated cases in arbitration. Where I directed the 4 major programs in the Classification and Pay Division, one being the Classification Grievance Program. We also had a post-audit program where we evaluated the classification decisions made at the agency level. We also had a technical services division, which was responsible for actually 2 sections in there, which established and maintained the classification plan and served as agents of the Governor's Executive Board, making changes to the classification plan. Subsequent to that, I became the director of the Bureau of Classification and Compensation, which is the position that I retired from. And in that position, directed 4 divisions, one being the Classification and Pay Division, Workplace Safety and the C Program, Employee Benefits, and the Salary Administration Division.
And when did you retire from Commonwealth service?
2009.
And you indicated that you testified in arbitrations. Have you testified in both grievance arbitrations as well as interest arbitrations?
Definitely grievance arbitrations with respect to various types of classification grievances. And to the best of my recollection, I believed I testified in one interest arbitration for the H-1 unit, but I can't recall the particulars of that. It was a long time ago. I would need access to my files to say exactly what the issues were.
And has the PSCOA asked you to provide a report regarding 3 different classifications within its unit?
It has.
And did you undertake and generate a report for those classifications?
Yes.
And what classifications were those?
Corrections and corrections commissary clerk.
And where do each of those fall on the pay scale grade for this particular contract?
The corrections wastewater and water treatment plant foreman are at pay scale group 35. Commissary clerks are at pay scale group 30.
Now, though, that 30 and 35, those are CO 30 and CO 35 pay scale groups?
That's correct.
And that's unique to this particular unit?
Correct.
Okay. And did you provide a report regarding your analysis of those various positions?
Yes.
Okay. And I would point out those reports are at tab 3 and tab 4. Mr. Winters, I'm not going to even suggest that I have the same knowledge as you, and so what I would ask you to do is to provide testimony to this panel in terms of the process by which you evaluated these positions and what conclusions you drew in terms of whether or not they are appropriately placed on the pay scale grade, and if not, where they should be.
Okay. Let me begin by introducing my fellow panel members. I'll ask them to provide their names, their work locations, and just a brief employment history with the Department of Corrections, starting with Mr. Furrow.
Thank you. My name is Gregory Furrow, G-R-E-G. I am the wastewater treatment plant foreman, and I was hired as that at the Cohana boot camp, and I'm approaching my 10th year.
Hi, my name's John Rigg, J-O-H-N-R-I-G-G. I've been with DOC for the water treatment plant foreman for roughly 9 years now. I've had my water license for going on 28 years, but I've been with the DOC for 9. Thank you.
Hello, Sherry Brennan, S-H-E-R-R-Y, B-R-E-N-N-A-N. I am right now the commissary clerk at SCI Mahanoy. I have 17 years in the corrections. I started at SCI Retreat as the library assistant. I went to records from there and then commissary. And when SCI Retreat was closed, I was transferred to SCI Mahanoy.
Thank you.
Before I provide the key points regarding the first demand, which is for wastewater and water operators, I think it's important for the panel to have an understanding of the classification and pay scale group construction of the pay schedule. The H-1 bargaining unit consists of 43 classifications that are assigned to 5 different pay scale groups. The groups are 30, 32, 34, 35, and 37. The bargaining unit's 2 trainee classes, corrections officer trainee, forensic security employee trainee, are assigned to pay scale group 34. This pay scale group is a condensed range with only 3 hiring rates of pay based upon the location of the facilities and the ability to attract candidates for employment. Therefore, essentially the H-1 unit has 4 complete salary ranges to which 41 classifications must be assigned. The distribution of these classes by pay scale group are as follows. Pay scale group 30, 2 classifications, corrections community center monitor, and corrections commissary clerk. One of the issues today, corrections commissary clerk. Pay scale group 32 has 1 classification, corrections stock clerk. Pay scale group 35 has 12 classifications, corrections officer 1, forensic security employee 1, and a mixture of clerical, food service, and maintenance type work. The wastewater and water operator classes are assigned to this group, 35. Pay Scale Group 37 has 26 classes: Correction Officer 2, Forensic Security Employee 2, and a variety of classes that includes trades instructors and correctional industries factory foremen. Administration principle that an equitable job grading approach should rank jobs according to the level of skill required, the amount of responsibility expected, and the amount of experience in type training and/or education and special qualifications necessary to be employed and perform the work required of the job. I was also guided by the Commonwealth Personnel Rules, Section 5.2, Maintenance of the Pay Plan, that requires that jobs be assigned pay rates based upon the following factors. 1, the relationship of the job to other jobs in the pay plan. 2, the duties and responsibilities of the job. 3, the ability to attract and retain employees in the job. 4, prevailing rates for similar jobs in the public and private sector. 5, cost of living factors. And 6, any other appropriate factors. I will now provide my analysis and arguments for pay scale group adjustment for the wastewater and water operator classes from 35 to 37. These arguments will compare and contrast pay scale group 35 and 37 classes to the operator classes. Demographically, there are 10 filled water operator positions in the Department of Corrections: Quehanna, Camp Hill, Dallas, Huntington, Muncie, and Rockview. There are 3 operators at Rockview, 2 operators at Huntington and Muncie. Quehanna, Camp Hill, and Dallas have 1 operator. There are 6 filled wastewater positions at the following facilities: Quehanna, Frackville, Mercer, Dallas, and Laurel Highlands. These facilities have 1 wastewater operator, except Laurel Highlands, which has 2 operators. The function: water treatment plant and systems operators manage a system of machines and equipment to transfer and treat water. That treats the water to ensure that it is safe to use and consume. Wastewater treatment plant and system operators remove pollutants from domestic and industrial waste. The used water, commonly known as wastewater, travels through sewer pipes to a treatment plant where it is treated and returned to streams. The work: the typical tasks performed by these operators include adding chemicals such as ammonia and chlorine to disinfect water and other liquids, inspect equipment regularly, monitor operating conditions, meters, and gauges, collect and test water and sewage samples, document and report test results to regulatory agencies, operate equipment to purify and clarify water and to process and dispose of sewage, clean and maintain equipment, tanks, filter beds, and other work areas. They also follow U.S. Environmental Protection Agency and DEP regulations, and finally, ensure safety standards are met. In order to perform these tasks, the operators must possess the following qualities: analytical skills, be detail-oriented, have math skills, and mechanical skills. These qualities are necessary to conduct tests and evaluate results, monitor machinery, gauges, dials, and controls to ensure proper system operation to meet regulatory agency standards. They apply data to formulas that determine treatment requirements, flow levels, and concentration levels, and to operate, repair, and maintain equipment. Appendix 1 and 2 in the report are the Commonwealth class specifications for corrections wastewater treatment plant foreman and corrections water treatment plant foreman. These specifications define the work, provide illustrative examples of work, list the required knowledge and skills and abilities necessary to perform the work, the minimum experience and training requirements the Commonwealth requires to be considered for employment, and a necessary special requirement. The comparisons categories: licensure certification requirements, minimum experience and training requirements, nature of the work and consequence of error, work environment and work schedule, and finally, the type and depth of work regulation. The first category, license and certification requirement comparisons. Pay scale group for pay scale group 35. In Appendix 3, it illustrates the jobs which require licensure or certification. Also the license term, the issuing agency, and any continuing education required. As the panel will see from viewing Appendix 3, only 2 classes other than the wastewater and water operator classes require licensure. That is the corrections equipment operator and the corrections licensed barber manager. The equipment operator class requires a CDL issued by PennDOT with a 4-year renewal requirement. Continuing education is not required. The barber manager class requires a barber manager license issued by the Bureau of Professional and Occupational Affairs in the Department of State. A 2-year license renewal is required, but continuing education is not required. The wastewater and water operator classes require licensure by DEP with a 3-year renewal requirement. 30 hours of continuing education is required during the 3-year license period, and the education must be approved DEP education courses. No other pay scale group 35 classes require licensure. It is clear from Appendix 3 that the wastewater and water operator classes require more rigorous professional preparation than any other pay scale group 35 classes, even the 2 that require licensure. Appendix 4 is the DEP publication, Operator Certification Program at a Glance. The publication describes what it means to be a certified water and wastewater operator, how a citizen becomes a certified operator, a summary of the certification process, and the types of certifications or licenses and subclasses based on the systems operated. Most notably, DEP mandates that only a certified operator can make process control decisions at a water and wastewater system. A process control decision is any decision that changes or maintains water quantity or quality of a water or wastewater system in any manner that may affect public health or the environment. Appendix 5 illustrates which pay scale group 37 jobs require a license or certification. These pay scale group 37 jobs requiring a license or certification are corrections equipment operator instructor, corrections barber instructor, corrections cosmetology instructor, corrections automotive trades instructor, and corrections refrigeration mechanic trades instructor. The equipment operator, barber, and cosmetology instructor licenses are state issued, but do not have any continuing education requirements. The automotive trades instructor job requires an active motor vehicle air conditioning technician certification and is issued in 2-year periods. These certifications are issued by approved companies, not government agencies. 16 hours of continuing education is required for certificate renewal. The refrigeration mechanic trades instructor job requires an active universal refrigerant transition and recovery certificate. Certificates do not have to be renewed, so continuing education is not required. These certificates are required by EPA because of possible environmental impacts of improper handling of refrigerants on the ozone and climate. This regulation is environmentally analogous to the purpose of the certificates required of the water and wastewater operators. No other pay scale group 37 jobs require licensure or certification. Therefore, it must be concluded, based on this category, that the water and wastewater operators require a level of preparation and professional recognition that no other pay scale group 37 jobs must meet. The pay scale 35 and 37 comparisons based on licensure and certification indicate that the operator should be assigned to pay scale group 37. The next category for comparison is the minimum experience and training requirements as found in the Commonwealth's class specifications. Appendix 6 illustrates what I'll call the METs, short so I don't have to keep saying minimum experience and training requirements, for all pay scale group 35 classes. This chart shows that the operator classes require more experience and training than all pay scale group 35 jobs, except maintenance foreman. While the maintenance foreman class requires 4 years of applicable work experience, the operator classes require 1 year of experience, according to the METs. However, the actual work experience required is found in the certification requirements. Up to 4 years of work experience is necessary to sit for the licensing examination and to become licensed or to receive a certificate. The necessary work experience varies based upon 2 factors: educational level and the class of the system certified to operate. An analysis of these 2 factors, where DOC operators are employed, indicates a range of work experience from 2 years to 4 years. Therefore, although the operator class specifications would seem to indicate that only 1 year of work experience is required, however, when you consider the DEP requirements for certification, the amount of experience is beyond 1 year. Regarding education, the operator jobs are the only pay scale group 35 classes that require a high school diploma or GED. It is therefore clear that the operator classes require far more preparation to be considered for employment than all other pay scale group 35 jobs, yet they are assigned to the same pay scale group. Appendix 7 illustrates the METs for all pay scale group 37 jobs. 5 jobs have a high school diploma or GED requirement, like the operators: garment, general industries, laundry, soap, detergent, and wood furniture factory foreman. The cosmetology trades instructor requires a high school diploma or GED for licensure, although it doesn't reflect that in the METs. The remaining 16 classes at pay scale group 37 do not have an educational requirement. Appendix 7 also illustrates the amount of applicable work experience required to be considered for employment. This amount varies from a low of 2 years to a high of 5 years. The work experience requirement for wastewater and water operators falls within these ranges at pay scale group 37. Therefore, it is clear when comparing the educational and work experience requirements of pay scale group 37 classes with the operator classes at pay scale group 35, these requirements are comparable, further supporting a pay scale group change to 37 for the operator classes. The next category for comparison is the nature of work and consequence of error for jobs in pay scale group 35 and 37. According to the DEP website, certified operators must make all process control decisions. A certified operator must be on site or available there is a need to consider or make a process control decision. Non-certified operators cannot make process control decisions. If they do, they are violating state law. However, certified operators can direct non-certified operators to take action using standard operating procedures, which must be written by a certified operator. When a standard operating procedure is used by a non-certified operator, it is the certified operator who is held responsible by law for the proper operation of the system. The work of these operators is highly regulated to protect water for human consumption and to eliminate the environmental impacts of improperly treated wastewater. The nature of work of the 2 pay scale group 35 jobs requiring licensure, equipment operator and barber manager, does not favorably compare to the operator's work and the consequence of error inherent in their work. Pay scale group 37 jobs largely fall into two categories: trades instructors and correctional industries factory foremen. The work of these jobs and the consequence of error inherent in the work is arguably not sufficiently different to warrant the operators being in a lower pay range than the pay scale group 37 jobs. The next category will compare work schedule and work environment. Water and wastewater plants operate 24/7. Certified operators must be on site or available 24/7 to make process control decisions, or direct non-certified operators to make such decisions according to their SOPs, standard operating procedures. Pay scale group 35 employees, other than water and wastewater operators, are not required to be available 24/7. Similarly, pay scale group 37 employees are not required to be available 24/7. The work environment for water and wastewater operators is challenging. They work indoors and outdoors in all kinds of weather. They also work in noisy conditions, cramped areas, and on walkways that can be slippery. They are exposed to and handle hazardous materials, so safety precautions are of paramount importance. Pay scale group 35 employees do not work in comparable work environments, except possibly utility plant operators. Several pay scale group 37 jobs do work in comparable environments. Therefore, this factor also supports increasing the operator's pay scale group to 37. The final category for comparisons is the type and depth of work regulation. The wastewater and water operators' work is subject to stringent regulation by DEP based on state and federal regulations. Numerous reporting requirements must be met, and test samples must be drawn and sent for laboratory analysis. Their plants are subject to on-site inspections with limited or no notice. Pay scale group 35 jobs have limited or no regulation. Pay scale group 37 jobs have limited or no regulation. The type and depth of work regulation for the operators surpasses that necessary for pay scale group 35 work, and even arguably pay scale 37 work. Increased to 37. Appendix 8 contains several photographs from the water and wastewater plants at Quehanna Boot Camp. These have been included in the panel's binder to give the panel an appreciation for some of the type of equipment in the plants and the type of testing that they do. If the panel so wishes, I can have the operators from Quehanna go through the photographs and tell you what they reflect or what they represent. Finally, this report also includes an auxiliary demand for a pay adjustment for employees in the operator classification should the panel award a pay scale group increase to 37. This argument charts the pay scale group history for the operator classifications in just one example of a pay scale group 37 class, laundry foreman, although it could be used for all pay range 37 classes. This argument, this argument cites the historical pay disparity between the operator classes and the laundry foreman class, despite the fact that these comparisons would have been valid at any time during the 20 years that this pay scale group disparity existed. Based upon this historical pay disparity, the union asked that the arbitration panel consider an award of 1 or 2 pay steps if pay scale group 37 is awarded. As part of the full report, Commonwealth personnel rules as they relate to how pay scale group adjustments are treated. I won't go into a lot of detail, but this panel will concede that it doesn't meet the test in the personnel rules. However, we believe that because of the historical pay disparity that has existed, if the higher pay scale group is awarded, a 1 or 2 pay step adjustment should be awarded to the employees who hold these classifications. Under ordinary circumstances, a pay scale group change without a substantial change to the work of a job would require or call for the slotting of those employees at their same rate of pay in the higher pay scale group, we believe the historical pay disparity suggests that a one or step increase should be awarded if the panel awards PSCOA Group 37. That completes the water and wastewater operator, and as a matter of
We'll have our witnesses kind of go through the pictures, and
Sure.
the binder book is here for our witness table. And while you pull those pictures out, can I ask you gentlemen, what does it look like in terms of cost to prepare yourselves to get to the level of training to even become certified for your jobs?
Well, from a testing standpoint, there needed to be 2 years of employment prior to even be able to take the test. So I had to be employed at another facility prior to even being able to take the examination to become a certified operator. I worked in conjunction with a facility manager from Penn State to enhance my schooling to get me ready. So actually it took about 6 months of study and testing, pre-testing, to get ready for the examination itself. From a cost standpoint, it's kind of tough to put because a number on it because I did a lot of it on my own. So there wasn't a school that I went to, though I do have college experience that I was bringing to the table pre-testing. So I couldn't necessarily put a figure on it, but no, there was 6 months of intensive studying to take the exam, plus 2 years of actual work experience prior to even being qualified to take the exam.
Is there a cost associated with the exam or renewing your licensure?
There is. I think there was. I think the exam itself was like $180 to take the test, and that included every. California State University has a field study operation program that I was able to get my hands on, as well as some DEP modules that allowed me to study. So I didn't have, at least for me personally, I didn't have an outlay of cash as far as studying, but it was probably $150 to $180 initial fee to take that, and there's a $60 license renewal fee that I pay out of pocket every 3 years. The continuing education classes, we've been fortunate enough to align with Pennsylvania Rural Water, which provides them, of which the DOC is a member. So we're giving those getting those at a discount rate, of which the facility of which I work, the Eckenrode Boot Camp, is providing the fee for that.
Okay, so right now, in terms of maintaining your status, the cost of the licensure or the renewal is on you. All of your experience in order to even get the job was on you.
Absolutely, 100%.
And by virtue of the relationship between the DOC and the PA Water, you're able to get your continuing education.
Absolutely, and I'll speak on behalf for Mr. Rigg as well from the water standpoint.
Okay, and if I could have you guys then go through the pictures there, what are we looking at?
Okay, so we on picture number 8. Is that what we're on?
Well, that's the appendix number, so the actual, each picture is not numbered, but that'll call attention to the appendix in the report. So
Okay.
Describe it and then explain it.
Yeah, the initial picture we're looking at is essentially an ammonia test. It's the styrofoam with the little vials in there. It's a test that needs to be provided as per DEP 3 days a week. We test for the ammonia in the wastewater, and these tests that I'm speaking would be wastewater tests. If we go to the next slide, it's a picture of the front section of our panel box, and I'm sure if we took a show of hands, how many people have ever been in a wastewater plant in this room, it would be extremely minimal. But this is what we deal with every day, and I think it's somewhat surprising when people come into our facility and see the electronics and the sophistication that's involved in trying to get the water as clear as we possibly can before we discharge it. So in essence, that's a panel box which is kind of the brain of the entire operation, of which we set parameters, control switches and program. So if we go to the next slide, it's basically a flow report. These reports that we do in-house, some of which are required by DEP, they like to see these. If you see that would be a minimum, maximum, average. That's a gallons per day flow that is going through the Crehanna boot camp. The importance of this one would be if I walked in the morning and I saw that some sort transpiring, because at 2 o'clock in the morning at the Crehanna boot camp, you really shouldn't be getting more than 2 or 3 gallons per minute. I've seen it at 15. That might be an indication of infiltration. It might be an indication of a commode stuck, somebody left something running, sink. It gives a minimum, maximum, average, and a totalized gallons per day. If we go to the next slide, essentially these are all DEP required. I test for the pH in the influent. I test for the pH in the effluent. Influent being inbound, coming in, raw sewer coming into that plant. The little EFF would be what I'm producing into the discharge stream at the end of our plant. Again, you can see that INF AMO, that's influent ammonia, EFF, effluent ammonia, effluent being outbound again. The DO is dissolved oxygen. We do a settle test, which is that little SBR, SS columns, and those are parameters that we like to keep. Those are process control changes that are made to make sure that we're getting enough supernatant, which is clear water, on top of the SBRs before we decide to send it down to the stream. We go to the next report, is basically an hour report. That's the biggest indicator for me from a maintenance standpoint. I keep extremely detailed maintenance logs. I'm testing, I'm greasing blowers weekly, and these are indicators of what kind of shelf life we're getting on our mixers, our pumps, and these are, this particular page is used weekly to determine which of the equipment is up for scheduled oil changes. If we go to the next one, which would be an inside look of the panel box that you saw earlier, you'll see a series of fuses, relays, switches, phone lines, and basically electronic controls and wires that would be, if you will, the brains of the operation behind setting that plant up. If we go, as well as an alarm system. The alarm system, which is the reason for the phone lines, in the event that there's ever an alarm, it calls control. At home. Like Mr. Winter said, we're on call 24 hours a day, 365 days a year. I've been called in numerous times for various items that are stuck, wore out, or an alarm just going off. The following page is just a close-up view of the brains of that outside panel box. You'll see react, fill, settle phase. These are just phases that I've programmed into this operation. If you want to know what kind of process control changes or issues that we have on our end that sometimes become seamless that nobody knows, the brains of this operation went out about 3 months ago, and when it went out, we literally had to run, Mr. Rigg and I ran this plant 24 hours a day for probably 3+ days until we had one of these particular units, which was configured perfectly for our system, flown in until we replaced it. So we would have been there a week and 3 days until this thing came. There was no leaving it. There's nobody else in the facility qualified enough or knowledgeable enough to know when to turn blowers, pumps, or any kind of other switches on the front of that machine you looked at earlier. So this was a good picture that was taken of the actual brains of that operation and a little bit about what we look at every day. If you go to the following page, you'll see high flow dash to prevent storm mode. Essentially, this was a little SOP that I wrote. The reason I wrote it, years ago, prior to us buttoning up any kind of infiltration issue. If we got in excess of 1.5 to 2 inches of water in any given time, there would be so much excess water coming in, the plant was not able to handle it on its own. So then you get into a process control situation. We literally have to double cycle it, and we're manually running it. Again, no one in the facility other than the 2 people sitting here staring at this camera and you guys are capable of doing this. The following page, SBR phase times. This is just the programming that I've put in each specific phase, and they don't mean a whole lot to anybody here, but essentially we have two separate tanks that run in opposite cycles that we're filling up, treating with a series of mixing and aeration. We settle it out, and then we discharge it into a stream. We're given some volume measurements here on the tanks underneath that, but this is just important from us from a phase standpoint, and this is the way I have it configured to give us the maximum clarity of the water when we discharge it. The next page is the digester EQ tank. These are just basically levels. The HWL, basically high water level. If a tank would happen to hit either one of those levels on the digester EQ, an alarm would go off. These are just parameters that I've set to give me enough time and established an alarm system in the event that there's an issue, whether it be a pump or high water that comes in and allows me to handle it. The following page is a rain report. It doesn't mean as much to us now as it did 2 years ago, because 2 years ago I had a major infiltration issue, but DEP is really key on this. And when they come in, they like to see my rain report, which is an indication of, are we getting infiltration? Hey, you had an inch of rain yesterday. I noticed your flow went from 20,000 gallons to 23,000 gallons. That didn't happen by accident. So DEP comes to me and says, listen, we need to find out where this infiltration's coming from. So typically Mr. Rigg and I will be out pulling manholes and checking seals to make sure there isn't any surface water getting into our system inadvertently. So that's the importance, and I keep track of the rain gauge every day. We record it. The next sheet is a UV light report. DEP likes to see this. Our disinfection process at the boot camp, we utilize ultraviolet light. Some places use chlorine gas, and various items, but we keep track of how many hours the lights were lit. A wipe is basically a cleaner that goes across the bulbs and keeps them clean, and this is essentially just to make sure our disinfection process is exactly on point, because when we test for fecals to the laboratory of which DEP gets, we want to make sure they're non-existent. So the last one, the last picture, the next one I guess, is a picture of that UV system, the ultraviolet lights. You can see 2 stainless steel canisters side by side. In those, there's 3 high pressure bulbs that essentially kill any and disinfect anything that may be coming down the line. That's our disinfection process. So we use one at a time, so we have system redundancy there. So my last sheet would be my weekly report, of which I keep track of my flow. It's just a weekly report of the monthly that you saw earlier. It's redundant for us. It's just a little easier. This report I've included is lower than you can see the parameters there. You know, it indicates it's the SOP that we add pH regulator, which we use soda ash. If the alkalinity is between certain parameters, it may require us to add soda bicarbonate to increase that as well. So probably a little bit long-winded, but I think I had more pictures than Mr. Riggs, so probably not as bad. So I'm going to pass it to him. What you get from here on out is from a water perspective.
Thanks. Appreciate it.
All right, the first sheet we're looking at is a consumer confidential report. What that consists of it's a years-long process of taking notes and all that kind of thing. If we did have any kind of violations or anything, we would have to put it in this report. And for as far as at the boot camp, at every housing unit, I have to post one of these at every unit that the prisoners are in, so they can, if there was any problems, I would have to notify them that there was something going on. Thank goodness, as long as I've been there right now, we've never had any problems. So it's a kind of a bland report for them, but they do get to see what all of our chemical results and all that stuff from the labs are all consisted in that report. So that's a very important tool for us DEP, because if there is a problem, that's when they're looking at me to see why it happened and when it happened and things like that. So as far as on that aspect of it, we've been very, very fortunate, and everything has been very good for us. So the next page is a chemical mix page. This is kind of like an SOP also, because on some of the days that if I'm not there, that someone else is doing it, it gives them the mix ratio of how to mix the chlorine, the Sequest poly that we add, as soda ash, and I also add a Sequest poly down at my pump house, which is off the grounds. But like I said, this stuff is supposed to be done, so that's the page 4. The next page is the chlorine report. We do a daily reading of the chlorine report, and at the end of the month, this gets turned into DEP. They regulate this. I have to keep a certain residual of chlorine throughout the system at all times. So this gives them an indication of what my chlorine is doing every day. We also have a monitor on the wall. It's called a CL17 chlorine monitor, and then it gives us a day-by-day report. I mean, it can be seen all the time. So, but this here report here gets sent to DEP monthly, so they know what we're doing. And we also send a report to the lab every month for just that the lab checks our chlorine results and all that stuff. A Form 42 page it's a sitting plan that I had to draw up for DEP. I have different test locations throughout the boot camp facility that I have to, we test monthly. So one month it might be at my building, the next month it might be at the wastewater plant, and there's different locations throughout the system that we grab a sample, and it gets sent to the lab, and then that's all gets reported to DEP. The next page that you see here is sample site 702 is the Quehanna building, Quehanna admin building. 801 is the PennDOT building and the wastewater treatment plant. Like I said, those are the months that I have to go to those particular places to get my samples. DEP, they're coming out with multiple different rules and regulations that you have to follow. This plan here is the DRR sample and sitting plan, and it's basically the same scenario, but they do different testing on the water for this particular one. But it's at the same sampling points as my other ones, but so that's how that goes. And the next page is roughly what I have to mark down for every month, then that gets reported to DEP. The next page is this is what's in my water plant here. This is for the fire suppressant system that for the boot camp that I have to log and maintain how many hours it runs or however long it runs and stuff like that. So we keep a log on all that kind of stuff, and that's a daily log. And that also gets tested yearly. The next page is actually a picture of the pump system that runs for our sprinkler systems and all that kind of. Factory that is a flooring factory that is roughly just adjacent to the boot camp. We also supply them with water and fire suppression with these particular pumps that we have here. So I have to maintain, exercise the valves, and keep a track, make sure that everything's all good with that kind of thing. So that's that keeps us. We exercise the valves twice a year. That's one of the things we do with the fire suppressant system also. The next page is at our reservoir. I have two different pump systems down there, and they alternate back and forth, and this just keeps a track of how many hours they've run, when they've been greased, and different things like that. So, it's just something that DEP keeps us. So we keep a track of what's going on with all the pumps, and so we know how many hours and everything, all that stuff works. Next page is the program procedures for all the testing that I do. I test for chlorine, phosphate, iron, and manganese. And what all you see there is the picture of the two meters that I use and the program numbers that we put into the computers. One of the things that I have it posted for there is when I do have inmates out, it gives them a chance so they can look at the wall and go, this program 9 is for chlorine, program 79 is for the phosphate and stuff like that. So it gives them more of a hands-on experience as far as when they do the testing and stuff, so they can look up and see what goes where. So the next picture we have is actually a picture of the two different pumps that I have down at my reservoir, and like I say, they alternate back and forth, and like I say, we have to monitor those as far as on the hourly on that one report we've seen ahead of that. Now the next pump is actually a picture of some pumps that are actually in my building, my water plant building. What these pumps here do, if you can see there's a big blue vessel above it there. Those are actually my pressure tanks, and the water comes from my outside tanks and back into the building, and this is how I supply water pressure throughout the system, is my maintaining the pressure in both of these big tanks here. So it just gives you a little bit of idea of some of the things that we do. The next picture is a picture of the generator down at my reservoir. If we have any kind of electrical outage at all, this generator will kick on in roughly a minute after the power goes out, and it'll run my pumps down there for as long as it takes for the electric. We've had problems in the past where some power lines have got knocked down by trees and stuff like that. The generators ran. By the time they come in there, it took them over 4 days to get everything back online. But like I say, the generators work flawless, so everything worked really good. The next picture we have is a sample of some of the testing that we do. That's some of what the bottles look like after we put our tablets and stuff in there, or pill packets in there. Like I say, the pink ones are the chlorine. The little blue one is the phosphate. The iron you really can't tell; it's almost clear. And the 3 orange ones are the tests for the manganese test. The next picture is, I have to keep these posted for as DEP's regulations. Whenever the DEP rep comes in, they want to know where our sample points are, and like I said, we keep these all laminated and posted, so they know where, if they wanted to go check something out, they know where to go. So whenever they do go to that building, this is where the sample point is. And the next picture is actually a picture of that. That is at sample point number at sample point 101. That is at the water plant, and like I say, that's just an indication that where the sample site is. This sketch here is actually a compact design of what my plant consists of. On the left side there, it says there's a clear well. That's where well number 2 is. We pump water from the well to the clear well. We pump it up to the 2 tanks. One of our tank holds 257,000 gallon, and the other tank is 77,000. Those are our raw water tanks. We pump that water into the building, and then we treat, and we keep roughly about 105. and some thousand gallon of treated water on hand at all times, and with that much water, as much as we use, if I did have a big problem, I could probably go about a week and a half before I had to get something done drastically. It had to be done. So the next page is just some SOPs of how to come in and turn the plant on if one of us is not there. Just the standard operating procedures on how to basically turn the plant on. The following page is if there is a fire alarm, because we do access the flooring plant that we do fire protection for them. If there is a problem, they say we either notify Jim Shirey or myself, and get things handled if anything did go bad. So. Just the last one of the pictures. Next picture is just a series of valves that is in my building that go throughout the system. The next page is just an hourly report for down at my pumps, and that last page is actually an hourly just how many. It's a well depth chart. One of the things I have to do at my well, I send a probe down in daily to get, let's see how much water is in my well above the pumps, and that's required by DEP also. So that's kind of a synopsis of what we do a little bit. All right, thank you.
Did you have any questions regarding this particular report before we move into the commissary clerk?
No, don't have any. I'll just be real quick. So for the two of you gentlemen, just to be clear, yes. Before you engaged in pursuing certification?
Yes.
And so you took a certification exam?
Yes.
Correct. Okay. Well, what was the and you had to, obviously we've established that you had to pay for that. What was the nature of that exam? Was it like a written exam, then like an oral interview or anything like that?
It was a it was about 100, probably 100 questions per classification. It was pretty involved. It was multi-choice. It was, I think my exam took 6 hours. It was an entire day event in testing, and there were some people there that didn't pass. You know what I mean? So it's not like it was pretty involved. So I came from a math perspective, and so there was a lot of math, and when from an exam standpoint, I felt like it was a pretty involved, detailed exam.
When you took the exam, were you taking it with other folks that were just part of the Department of Corrections or state agencies or private sector?
No, we were certified prior to getting our position.
You were?
That was part of the prerequisite, having a license to be employed.
Understood. Just like in the H-1 bargaining, they have locksmiths. Some of them come from outside, and they've got their certifications and training. You did the same thing.
Exactly. And there's different tests depending on different water exams, wastewater exams. So you're going to take a test specific to the plant that you're going to be running.
All right.
So,
and beyond that, and as part of that, you're certified, and then beyond that, you have to do continuing education.
Correct.
Absolutely.
Okay. And I think you said, is that every 3
every
3 years?
Yeah, we have to have 30 hours of class time.
Okay. And there were a lot of photos in here about that showed pumps. I mean,
absolutely
engaged that are part of those cylinders that we saw. Are you the person that maintains that?
Yeah.
Correct.
That's it.
And
Between the both of us, we rebuild the systems and.
Water, wastewater,
whatever we
we're
do.
those guys.
okay, so you grease the fittings and then you fix it when it breaks.
Absolutely, and program it to do exactly what we need it to do, make process control changes, and anything that would need to be done. If there's a fuse that's blown, we're fixing it. If a pump goes, we're pulling it.
So Mr. Rigg is bringing the water in and treating it
He's
so that it
taking
can
it
be
out.
used, and
That's
you're
right.
taking it out.
Yeah.
That's right.
All right.
You'll be glad to know it's crystal clear when it comes in and crystal clear when it leaves. So I think in this day and age we can all agree on one thing, which is kind of rare nowadays, but we can all agree we want crystal clear water to drink, and it would be really nice to have it crystal clear when it goes back down the stream. So I think we can all come together on that.
I'll drink to that. Thank you.
Amen.
Ed, do you or Pat have any questions? Or?
So I just have a few questions at the end. I have no questions regarding the employees' qualifications or what they want to tell us about that, but I just have a few questions of Ralph at the end if I can. But that's
Do you
all.
want him to run into his commissary clerk report and then just do all your
Well,
questions
and
together?
what I would suggest too, I know he was reading from the document. If it speeds anything up, we don't have any objection to the documents being admitted too. So I can do it at the end. There are very few.
Okay. If you want to go ahead and move into your commissary clerk report then.
As part of the commissary clerk report, there are 6 appendices, which I'll identify up front. Number 1 is the commissary clerk class specification. Number 2 is the stock clerk class specification. Number 3 is the community center monitor class specification. Number 4 is a statement from Kimberly Pagera, who is a stock clerk who works at Mahanoy SCI in the Regional Distribution Center, which I'll explain in a few minutes. Also, number 5 is Robert Miller's statement. He's the VP of the Mahanoy local and has worked as a commissary clerk in the past. And finally, there are various photos of the commissary operation at Mahanoy, which I'll be referring to in my testimony. There are 35 filled positions in the commissary clerk classifications across the DOC facilities. The function of the commissary, every facility has a commissary. There are 3 facilities that host regional distribution centers. One is at Mahanoy, one is at Houtsdale, and one is at Albion. The actual commissary itself, where the commissary clerks work, can be considered, in my way of expressing it, the front end of the operation, whereas the regional distribution centers are the back end of the operation. At the back end, the regional distribution centers receive the commodities from vendors. They receive them, store them, pick them to fill the orders from the inmates. They pack them for shipping, and then they ship them to each of the state correctional institutions based upon the inmate orders. As I said, the commissaries are staffed by commissary clerks at pay scale group 30, the lowest pay scale group in the H-1 unit. The regional distribution centers are staffed by stock clerks at pay scale group 32. Stock clerks also work typical tasks of a commissary clerk include overseeing the receipt, sorting, storage, and distribution of inmate commissary merchandise received from a regional distribution center. They direct inmate workers in the receipt, storage, and distribution of inmate commissary bags. They verify order accuracy, inspect merchandise quality, and secure controlled items such as razor blades and e-cigarettes. They also use the SAP inventory system to scan orders, verify inmate status and locations, credit inmate accounts for damaged goods and items not received, and they also generate a variety of reports. They also update the commissary order system to reflect current inmate custody levels and locations based on inmate movement sheets and information from the Program Review Committee. They also ensure the proper routing of commissary orders to inmates who have been transferred to other facilities. One of the comparisons that I've used is work environment and the challenges associated with the work environment. Commissary clerks face many work challenges. These work areas are extremely busy. For example, at Mahanoy, where I actually did a visit and a tour, there are 2 commissary clerks assigned to the commissary room with about 5 inmate workers. Inmates report to the commissary vestibule area, which is outside the commissary room, to pick up their bags. They approach 1 or 2 of the windows where they present their ID and receive their bags. Inmates then check the contents of the bags to verify their orders are complete and that no items are damaged. Missing or damaged items are reported to the commissary clerk, where that information is recorded and inmate account credits are entered. 20 to 30 inmates are in the small vestibule area at any given time. The commissary clerk must watch for inmates passing merchandise to another inmate and then claiming that the items are missing. A corrections officer used to monitor security in the vestibule area, but this post was eliminated about 6 years ago. Therefore, the commissary clerks at Mahanoy are solely responsible for security in the vestibule area and closely monitor inmate actions for possible theft. While the commissary clerks are monitoring the vestibule area, they must also monitor their inmate workers who are working behind them, organizing and sorting the inmate commissary bags for distribution to the inmates. The commissary clerks must ensure that these inmate workers are properly organizing and bringing the correct bags to the commissary window. Secure items, such as razor blades, take great care and caution. They are not packaged in the commissary bag. The commissary clerk accounts for the distribution of new razors and ensures there's an even exchange, old for new, for each inmate. The commissary operation is Monday through Friday, with distribution sites scheduled for the mornings from about 8:15 to 11 a.m. and in the afternoon from 1 p.m. or when count clears to about 2:30. The commissary clerks also deliver bags to inmates in the restricted housing unit and the infirmary. As part of this pay scale group demand, I also reviewed the commissary operation at Phoenix, and I did that through a on the east side and on the west side of the jail. Each side has a commissary clerk. The work process prior to distribution of the bags is generally the same as Mahanoy, but the distribution system is different. Inmates do not report to the commissary to receive their bags. The commissary clerks assemble the bags for a housing unit and transport them to each side of the housing unit, where they are handed to the inmates. As each cell is opened, the commissary clerk watches the inmate inspect their bags for missing and damaged items. Commissary clerks direct inmates to recount and recheck their merchandise for items they claim are missing or are damaged. When discrepancies are resolved, the inmate signs a receipt for the merchandise, which finalizes the sale for inmate accounting purposes. This process is and can be contentious, with inmates becoming agitated because of missing and damaged items or a missing bag. This commissary clerk must adapt to these challenges and attempt to address these contentious face-to-face encounters. The volume of commissary work at Phoenix is considerable. 2 regional distribution center deliveries are received weekly. On average, 1,200 bags are distributed weekly per side. Commissary clerks are challenged to organize the housing unit deliveries and bag handout process efficiently, so at the end of the week, all bags are distributed and accounted for. The weekly value of commissary for one side could be as high as $190,000. That's weekly, and always averages over $100,000 weekly. 2 classification comparisons will be made to support our demand for a pay scale group increase for commissary clerks from 30 to 32. Stock clerks at pay scale group 32 and community center monitors at pay scale group 30. First of all, the stock clerk versus commissary clerk comparison. The nature of the work of these two classes is essentially the same, storekeeping work. A review of the Commonwealth's class specifications for these jobs reveals a significant overlap in all sections of the specifications. The examples of work area of the specification contains many entries that are identical or similar. Some examples are receiving, sorting, and distributing goods, utilizing the commissary computer system, SAP, ensuring the quality of goods, maintaining an inventory of tools and equipment, maintaining security by searching inmates in the work area for contraband, and supervising an inmate work detail. The required knowledge, skills, and abilities section of the specification examples are: 1, knowledge of storekeeping methods and procedures used in the receipt, storage, and issuance of goods. 2, the ability to communicate effectively in writing. 3, the ability to communicate effectively orally. 4, ability to establish and maintain effective working relationships. 5, ability to plan, assign, supervise, and inspect the work of an assigned detail. The minimum experience and training requirements for these two jobs, that is commissary clerk at 30, stock clerk at 32, are identical. The minimum work experience required to be employed in both classes is the same: 1 year of storekeeping or clerical experience. The current pay scale group disparity between the stock clerk and commissary clerk's job has existed since July 1st, 2001. The question for the interest arbitration panel is whether this disparity should continue or be eliminated. An analysis of the class specifications for both jobs suggests that there are insufficient differences in the nature of the work and the knowledge, skills, and abilities necessary to perform the work, and also the minimum experience and training requirements that have to be met to be employed in these classes to justify a different pay scale group for these jobs. Is to generally apply the principles of the Hay method of job evaluation. It's a widely used method in the public and private sectors. The underlying principles of this method are: 1, jobs exist to achieve an end result, that is, accountability. 2, to address this end result, job holders must address problems, create, analyze, and apply judgment, that is, problem solving. 3rd, the job holder requires a level of knowledge and experience commensurate with the scale and complexities of deliverables, that is, know-how. Therefore, the combination of know-how, problem solving, and accountability is an objective way to measure one's job worth against another's job's worth. A comparison of the commissary clerk and stock clerk jobs indicate insufficient differences in these 3 Hay method factors to warrant maintaining the current pay scale group disparity. Now let me address the comparisons to the community center monitors versus the commissary clerk. Both classes are currently assigned to pay scale group 30. The question for the panel to answer is whether the commissary clerk pay scale group should be higher than the center monitor job. This comparison is relatively straightforward. The basic differences between these jobs are the work environment and the minimum experience and training requirements found in the class specifications. Commissary clerks work in prisons. Center monitor The center monitor class specification is included in Appendix 3. There are no minimum experience and training requirements for the center monitor job, while the commissary clerk requires 1 year of related work experience. Therefore, the difference in work environment and required work experience indicates that the commissary clerk pay scale group should be higher than the center monitor job. As you previously heard in the water and wastewater pay scale group demand, there's also an auxiliary demand related to the commissary clerk pay scale group demand. An increase of 1 or 2 pay steps is also asked based on the historical pay disparities between the stock clerk and commissary clerk classifications. At this time, I could have briefly Sherry Brennan go through the photographs attached to the report to identify the various areas of her work area. Just give me a few minutes. Sherry, do you have the report? Okay, let me get you the pictures. There's only a few of them. Is Appendix 6.
That's just the front and back door, front entrance and exit that the inmates have to go through.
Sherry, I'm sure
It's
you're
on.
good. Okay, can you hear you through the mic?
Am I not talking? Yeah,
Okay, just get it closer to, there you go.
that's just the exit and entrance to where the inmates have to come into my building. The second picture is our commissary vestibule. The front windows is where they pick up their commissary, and then these little alcoves, they have their back to us and they sort out their commissary right there. Same thing, it's just a different picture, different angle. These are our front windows to where they come in, give their IDs to us, and then get their bags out. The next picture is the inside of our operation, where myself and my coworker and our 5 inmate workers hand out the commissary. These are all the commissary bags just for one block. It goes back farther. These are all the bags that we have to process and hand out in one session, a morning or an afternoon. Each day is assigned a block. One morning it'll be one block, and then the afternoon will be a second block. And then this is just closer. These are where we have our razors locked up on the last picture. And then this is where our e-cigarettes and razors are stored in a secure area so that we, just myself and my coworker, handle them.
Could you explain to the panel why e-cigarettes are controlled or a secure item?
They use e-cigarettes as bargaining and for paying off their gambling debts, so they can easily be stolen and lost e-cigarettes if that happens. And the same with razors. We have to make sure all razors are handed back with 2 blades so that a weapon isn't made out of our razors, which does happen.
Thank you.
You're welcome.
Any questions from the panel for our employee? Okay. We cross-exam for Mr. Winters.
And just for the panel, we will address the classification issues and any response to this presentation and our presentation. I don't really have any questions for the employees. I thank you for your testimony. I just want to clarify, Mr. Winters. So, Ralph, I don't know if you remember this. You may blank that out of your mind because I would. But you were my witness. Bureau classification, you did testimony. You remember that?
No, but refresh my memory.
I looked a lot better. I looked a lot younger than Ralph. So maybe,
what was the issue?
We just did a day in the life testimony of various functions and departments of H-1 DOC.
Are you sure that was me?
Yeah,
Okay.
because I remember, Ralph, you came in and talked about the Bureau classifications and how it works.
Oh, okay.
Yeah, do you remember that?
No, but
Ralph, this would have been, oh my God, 06 maybe? I'm trying to remember when we did that. It was.
I think I have a vague recollection of going to an interest arbitration.
Okay. So
and testifying, and it was in the mid-'90s.
I remember.
Yeah, it was
I
the
remember.
mid-'90s. Okay.
I'm not insulted. I remember.
Yeah. It was the Howard Flaxman days, I think.
And it was Tom Jennings, and it was sort of a wild one. Yeah.
Oh, okay.
Yeah.
Okay.
So I just want to ask you, because during this presentation, you did a great job as an advocate. You presented it better than some of the advocates in this room, and I'm not going to say who, but you presented the case, you presented the witnesses, and you kept saying we, and it's our position. So I knew you when you were the bureau director, and you said you retired in '09. Are you a consultant? Are you working for the union now?
That's a good question. Let me give you a little background on how I became involved in PSCOA matters.
Okay.
Had a very good friend, unwork related, of PSCOA, John Chernavich, later when his term ended became a business agent for Phoenix. He didn't know who I was. We struck up a conversation. He wanted to know my background. I told him what my background was. He said, "Oh, I've seen your name around. What did you do?" And I explained it to him. And he said, "Geez," he said, we have a new leadership now, and they have some classification matters that they don't know quite what to do with. Would you be interested in at least sitting down and talking to Hank McNair about some of the issues?" And I said, "Sure." And he said, "Do you have any reservations about doing that?" And I said, "Well, quite frankly, yes, some. But until I know the issues, I can't tell you whether I'd be interested or not." He said, "Well, why would you have reservations?" I said, "Because basically I'd be arguing perhaps a position that for people that worked under me. It would be a little uncomfortable."
Yeah, and that's fine, Ralph.
Yeah.
This is America. You have the right to do that, and it's fine. I'm just trying to clarify here, because whether you were testifying as an expert who was subpoenaed in, or whether you're a consultant and an employee of the union who presents cases, that's what I'm trying to clarify.
Ultimately, Mr. McNair asked me to review some classification grievances, subsequently these matters, and I have a contractual relationship. I'm an independent contractor for them.
Okay, so you're paid for your testimony in presenting these cases that you present?
Correct.
Okay, and what's the arrangement, or what, are you on salary, or what's the arrangement?
It's an hourly rate.
Okay, and what's that rate?
Less
I'm
than
gonna object to
less
that.
than I made
That's
the Commonwealth.
not relevant at all.
Okay, so you're not an expert witness. You're a consultant for the union presenting these issues.
I consider myself both. I consider myself an expert witness on the classification matters.
And Ralph, believe me, I'm not challenging your qualifications. Today, because today you seem to be an advocate who's presenting this case. You're not testifying as an expert today, are you? I'm not challenging your expertise, but it appeared you were an advocate today presenting the case. You're not saying, based upon my experience, based upon my former experience, I believe this should be this. You were presenting the case for the panel to decide. And you can tell me either. That's what I'm trying to confirm.
I'm presenting my technical analysis and opinions relative to the issues before the panel, these PSCOA group demands.
Okay, but you kept saying, we believe, we are asking. So is it you, is it the union, or are you testifying as an independent expert? That's why I'm confused.
It's PSCOA.
You're PSCOA.
Yeah.
Okay. And then you said these pay disparities have been going on for over 20 years.
Mm-hmm.
Back to when you were the bureau director, right? And I'm not trying to be snarky here, but did they ever come in front of you back then, like the job classifications for these gentlemen, or for this lady here? Did they ever come back for consideration back then, or were they looked at back then?
I never recall the water or wastewater operators. The stock clerks, canteen clerks, as the commissary clerks were then referred to, were an issue back in the mid-'90s in interest arbitration, and I'm not sure if I testified at that or not, but there was a series of PSCOA group issues that ASME, who was representing this bargaining unit then, and the Commonwealth had issues regarding.
Okay. And the other thing I'm confused on, you can clarify for me, you did a report, you did an analysis. It sounds like you did a visit to one of the prisons to look at the work site.
I did, for the water and wastewater, I did a visit at Quehanna Boot Camp. And for the commissary clerk, I did a visit at Mahanoy State Correctional Institution, which has not only a commissary, but is hosting a regional distribution center.
And then we wound up here where we're asking to change the pay classifications for these three job classifications. And I apologize. The one sounds really close. I don't know why they're the different labels, but
one's water,
right.
One treats water, one treats wastewater.
Okay, all right. I still need help, guys.
One is one you want to drink, and the other one is not.
I want to keep them separate. You really helped me. You're right. But here's my question, Ralph. before we got here, did you present your report to the Bureau of Classification so they could look at it, or did we just come right here?
Just right here.
Okay.
It was not presented to them. I presented it to Hank, and what Hank did with it, you'd have to ask Hank.
Okay. Thank you. I think that's all I had. I just want that.
If you have any questions from the panel. Thank you.
Thank you for your presentations today. Appreciate it.
Appreciate it, Mr. Winters.
Thank you.
With that, today the PSCOA will rest. Hopefully I can be a better advocate tomorrow, Mr. Harvey. And
I didn't say who I was referring to.
And I don't know.
You don't want to go there, Pat.
It could be someone on this table.
You don't want to go there.
It could be someone over here.
There's only another advocate over here.
No, it could be this table.
But I don't know that we need to start any earlier than 10 o'clock tomorrow, and we should be able to wrap things up in short order.
Okay, so we'll be starting at 10 o'clock tomorrow. Thank you all for your presence.
Thank you.